Good morning. It is 9 a.m. in New York City. This is Yahoo Finance Live. I'm Julie Hyman. I'm back, baby.
Hey.
This is Brad Smith right here next to me. Here are three things you need to know this morning. Bad news for the economy, still good news for stocks, but Goldman Sachs suggests things might not be that bad after all. It lowers its probability of a U.S. recession in the next year to 15% from 20%. September is usually a down month for equities, and investors have lots to digest ahead of the Fed's next policy meeting. It is largely expected to hold rates steady. SoftBank's ARM looking at a valuation of over $52 billion in its much-anticipated IPO. The so-called crown jewel of the tech conglomerate's empire is offering 95.5 million American depository shares for $47 to $51 apiece. That is lower than earlier estimates, by the way. SoftBank bought ARM for $32 billion in 2016. It'll still own over 90% of the company after its IPO. Its roadshow marketing the listing starts today. And counting the cost. Warner Brothers Discovery cuts its annual core profit forecast, saying the impact from the Hollywood writers' strike will drag until the end of next year. It now sees full-year adjusted earnings between $10.5 billion and $11 billion. The Barbie effect, though, still playing out. It's raising its full-year free cash flow expectations to at least $5 billion.
Well, August performed as expected, killing the summer stock rally and delivering a lousy month for markets. And now that September is here, investors are bracing for another potentially volatile month. So let's take a look at some of the biggest risks that we are watching for the month of September here. First up, it could potentially be another cruel month for stocks. Now, a few things that we're going to be watching, of course, the earnings that continue to flow through. You've got some household names that are going to be reporting over the course of this week, as well as some Reddit or retail investor names, GameStop, that's going to be set to come out. But I think more largely here, even as we think about the market performance, it's also going to be the amount of volume that we also see come forward and perhaps rebound from August, which is typically one of the months where many of the traders at desks, they kind of take that time, use vacation, and kind of using Labor Day perhaps as that kind of flank post, if you will, that really triggers, or some of that vacation time triggers lower volumes. But even at this time where we're still going to be set to hear from some companies over the month of September, you've still got names in retail, you've still got some of those household known names, and it'll give us a little bit more of a sense of where the consumer stands right now.
I mean, as we saw from that chart, historically, September does tend to be negative for stocks pretty clearly, although as our Jared Blickery wrote in the morning brief last week, he pointed out that performance, the average is really dragged down by several sort of anomalous Septembers out there when we've had big events, big downturns that have pulled down that average performance. If you pull those one-time big declines out, it doesn't look quite as bad, but we'll see how this September pans out. But that's definitely one of the risks, sort of seasonality. Another risk that we are watching for, the United Auto Workers are edging towards a strike, and there are different estimates here for how much that is going to cost the U.S. economy. One of those estimates from the Anderson Economic Group says even if a strike lasts only 10 days, we could see nearly $1 billion hit for the three major U.S. automakers, and that we could see losses mount up to about $989 million for those companies, nearly $1 billion, and wage losses as well of $859 million. So definitely that's something to keep an eye on, as well as a potential risk that could trickle through into the broader economy.
Yeah, interestingly, not something that came up on the most recent earnings calls for companies like GM or like Ford, but when you think about the hits to what this means for their electric vehicle production as well, a time where they're investing billions of dollars, have these significant kind of their own posts or at least goals that they're guiding towards. And this could throw a wrench in that plan. Just a matter of, the year that we've seen in terms of negotiations playing out in labor unions or unions at a whole here. This is just another one that car manufacturer investors out there have to consider, and what that would essentially mean to being able to get some of those new vehicles back into the dealerships as well. So that also, as we're watching one more big theme that could potentially play out over the course of September, and that is geopolitical tensions. They continue to rise here. And now there are a few ways to look at this. And of course, China has gotten a lot of the attention, and rightfully so, for the second biggest economy in the world and lagging some of the growth projections that we had seen. You've already watched Goldman, Citi, JP Morgan cut some of their GDP forecasts, Citi sitting at about 5%, and the World Bank, even for the projections that we've seen come forward over the course of this year. It's a larger question of where moving forward from here China takes actions that the market does not foresee coming in order to spur some type of economic growth as well.
Yeah, so you have sort of the economic backdrop squarely situated around China, and then you have sort of the more geopolitical backdrop as well. News today that Kim Jong-un of North Korea is planning to visit Vladimir Putin of Russia. News as well that Xi Jinping of China is not planning to go to the G20 in India. So those concerns have sort of faded into the background when it comes to market perception, at least, and market participants watching these items. But still, anytime any of this stuff sort of flares up and becomes more acute, could be a further risk to the market. So that's something else that they're watching. So we have three risks that we're watching, but we got one catalyst as well, because there might be some hope for markets after all. Corporate earnings could be a catalyst, as our Miles Udland wrote in this morning's morning brief. He pointed out that if you look at fact-set estimates for estimates coming down for earnings versus estimates going up for earnings, we're actually seeing revisions higher here earlier in this quarter, which is quite unusual. We haven't seen it happen since the third quarter of 2021. So could there be sort of a trough in the earnings performance? That could be one of the reasons that we have seen markets hold up fairly well.
Yeah, and for the results that have come in, we've largely been looking at companies that have been beating on some of the expectations that have been at the lower end of what investors perhaps looking for in this larger kind of growth environment, what they were looking for or hoping for at least. And so just beating on or having a relief move after beating on already kind of suppressed, if you will, not suppressed, but not great expectations.
Yes. Lowered expectations, exactly, to be sure. So all of this considered, we want to look ahead to what could end up happening in September and beyond. In the past week in particular, bad economic news was actually good news for investors. Stocks closed the week higher as cooler data from Friday's jobs report supported a narrative of a gradual job market slowdown that could signal an end to the Federal Reserve's rate hikes. But the positive reactions to softening data may soon end, and bad news could end up being bad news again for the market. Here to discuss is Jeff Schultz, ClearBridge Investments Head of Economic and Market Strategy. I mean, we kind of swing between those two, don't we? Between the bad news is good news, bad news is bad news, good news is good news, et cetera. How are you sort of thinking about your framing of the economic data and how it relates to the markets right now?
Well, last week was certainly a relief to those in the soft landing crowd. You saw rebalancing of the labor market. We've been waiting for it, and it finally appears to be happening. But I think if you look out on the horizon, you're going to continue to see the labor market weaken, and I'm not sure I see a catalyst to see it plateau and ultimately cause that soft landing outside of a Fed pivot. And I think the Fed is going to be reluctant to provide any type of stimulus to the economy because they don't want to repeat the sins of the late 1960s, which was the soft landing that they engineered, and they loosened or cut rates into a very tight labor market, and core inflation basically doubled, going from 3% to 6% over the next couple of years, and really kicked off that structurally higher 1970s inflation. So I think the Fed is going to be for higher for longer policy, and I ultimately think, although we're seeing signs of a loosening labor market, that we're going to see this ultimately lead to layoffs and the recession that everybody's given up on.
What does the Fed need to see in order for that pivot to be initiated then?
Well, I think the Fed needs to see the unemployment rate get above 4%, maybe 4.5% before they'd be comfortable cutting rates. I think that you need to see wage growth move down to levels that are consistent with 2% inflation. And with average hourly earnings in the latest release, that's a positive step in the right direction. But if you look at the Atlanta Fed's wage tracker or the employment cost index, still well above where 2% would ultimately be. So I think you need to see a greater softening in the labor market. And we have come off a boil, but the labor market's still incredibly tight right now.
So walk me through this then, because you have on the one hand what you're talking about with, yes, the recession is going to happen. You have on the other hand the likes of Goldman Sachs saying, well, we're putting our probability of a recession down to 15%. And among other things, the case they're making is that the Fed tightening, making its way through the economy, will not be as severely felt as perhaps some had perceived. I assume you think that's wrong. And tell us how you're sort of modeling this versus maybe how they're modeling it.
Well, if you think about Fed tightening, it works with notorious long lag times. It's hard to know when the rubber will hit the road with the economy. And it's important to remember that economy was very hot coming into this Fed tightening cycle. And the Fed only got above forward-looking measures of inflation with the Fed funds rate in November of last year. So we've only been in restrictive territory for, call it 9 or 10 months. It's going to take more time for that to work its way through the plumbing of the economy overall. But more importantly, if you look at lending standards, they've dropped pretty precipitously over the course of this year. And if you're looking at lending standards to businesses or consumers, we've rarely seen it this negative. So I think that's going to start to hit the economy in the fourth quarter into the first quarter of next year, ultimately provide that impetus for the layoff cycle and the start of the recession. But we're not there yet, and I will say that you're starting to see some tangible signs of weakening on the consumer front, and I think that's going to continue.
So with all those factors at play, how deep of a recession are you forecasting? Because you're talking about a horizon for a recession over the next, 2 to 3 quarters now?
I'm not anticipating a deep recession. I think it's going to be relatively mild because you don't have a lot of excesses in the economy that need to be wrung out. I do believe that as inflation comes down, it's getting to the point where the Fed could pivot a lot earlier than, say, inflation remains stickier to the upside. But on a scale of 1 to 10, 1 meaning a very shallow recession and 10 being a deep recession like the global financial crisis, I would imagine it'll probably be in the 3 or 4 range. So more of a moderate recession, given the fact that the Fed will be reluctant to cut as aggressively as what you've normally seen heading into economic downturns.
Okay, so what does that imply for stocks then?
Well, I think from the stock market's perspective, I think the path of least resistance is higher from here. We do get the CPI print in the middle of next week. I don't think the Fed is going to hike in September. And I know September historically is bad from a seasonality perspective. But I think at this point, bad news is good news when it comes to the labor market. And I think that's going to continue to be cheered by investors. But I think as we get to the fourth quarter and the later part of the fourth quarter, when it becomes evident that you are going to see more weakening and the consumer is not as strong as initially appeared, I think bad news becomes bad news and investors will start to price in maybe some lower economic activity and also potentially that recession that, again, everybody knew was a foregone conclusion coming into the year.
Is bad news really bad news when you have kind of other catalysts that investors point their attention to, whether that's AI or whether that's large chip companies potentially going public and perhaps opening up the opportunity or at least the pipeline therein? Because investors have picked and chosen their spots at this point.
Well, the average recessionary drawdown in post-World War II history has been 30%. I don't think we're going to get anywhere near that because there's a lot of investors that have missed out on the move for the Mag 7, the AI beneficiaries, and I think there's going to be a lot of buying the dip as this recession materializes. I think ultimately it's going to be something similar to what we saw ahead of 1990s downturn, around 20% peak to trough decline. But I do think that there's going to be really good opportunities for active managers to be able to navigate this landscape. And from a sector standpoint, I really like the defensive sectors given how cheap they become over the course of the last 5 months. So that's healthcare, utilities, and staples.
I was going to ask, is defensive still defensive? Like the classically defensive groups like that? It sounds like you think that they are because you're naming the ones that are sort of classically defensive, right?
Yeah, I think they are going to be more defensive. Utilities, one of the biggest gaps versus the S&P 500 that we've seen since the dot-com bubble burst. As interest rates fall and this recession is ultimately priced, I think they're going to fare a lot better. Also, I think when you have an uncertain earnings environment, those companies that provide a lot of visibility into that earnings stream will catch a bid, and we saw that coming into 2023, but we've seen a complete reversal of that. So I think that these stocks are pretty cheap, and they're going to do well on a relative basis. But the last area that I actually think there's an opportunity in is energy. You would think with the U.S. recession that energy wouldn't fare that well, and then that's typically the case. However, if China does do a bigger stimulus package than what they've done at this point, and I think that's going to be needed to take them out of the malaise that you're seeing over there, given the lack of supply that you're seeing in the discipline of shale producers and OPEC, I think energy can fare well in this environment and better coming out the other side of this.
All right, Jeff, stay with us. We've got much more to discuss this morning here. We got to pivot as China faces more economic roadblocks. A new forecast from Bloomberg Economics shows that the country's timeline to overtake the U.S. as the world's largest economy is looking weaker. China's GDP isn't set to surpass the U.S. until the mid-2040s, but Bloomberg economists warned that even then, it would be by only a small margin. Jeff Schulze, who is the ClearBridge Investments head of economic and market strategy, is back here with us. So what is the perhaps broader implication if a China outlook at least looks further out for how quickly that economy is set to grow and where other economies around the world might feel that as well?
Well, it's clear if you look at the data today with the services disappointing that China does need to view more stimulus, right? And they need to support the property markets. The one thing that they need to do is restore confidence in both consumers and businesses. And consumers are a little shell-shocked because China had signaled that they're going to loosen the 3 red lines on property developers in late 2021. And then they shut down the economy in 2022. And obviously you saw the biggest drop in the property markets there since the mid-1990s. So, consumers are shell-shocked after zero COVID tolerance policies. They're going to need a much bigger stimulus package in order to pull the economy out of the doldrums. And I think that is going to be forthcoming, even though it may be a couple of months till they come to that realization. But when that happens, you're obviously going to have a knock-on effect for not only China, but it's always going to be good for emerging markets. It's going to be good for Japan. And you're going to see some benefits accrue to Europe and energy and materials companies here in the U.S.
What makes you so confident? We've talked to a lot of people about China. A lot of them have said that stimulus is not coming. You'll get more of the same sort of trickle of stimulus that we've been getting, but we're not going to see the same size that they have done in the past. And it's interesting because even as we get estimates that the Chinese economy is not going to overtake the U.S., at least not on the same timetable that estimates once put it, that China hasn't come out and done the big stimulus. What would convince them to change their minds?
Well, I think from their vantage point, they think that this time is not different as compared to previous easing cycles where just the signaling effect created a lot more demand. For the first time, given what we talked about earlier with the consumer, you don't have that excess demand that the property market is going to continue to move higher and that policymakers will support it. So they're eventually going to come to that conclusion, just like they came to that conclusion with zero COVID tolerance policies at the end of last year when they ripped the Band-Aid off and opened up the economy very quickly. But I think they're going back to that old playbook, and when that proves to be ineffective, I think they're going to change their tune because they're going to have to. So unfortunately, it's going to take a little bit of time. And again, we may see some lackluster growth in the Chinese economy for the next 3 to 4 months until that reality comes home to roost.
Amid that lackluster growth, then, are there investment opportunities that are top of mind or investors could be thinking about within China at this point?
Well, I think at the moment you want to, sit on the sidelines until authorities act with a little bit more aggressiveness. I think it's going to take some time again for that conclusion to come through. But when they do, I think consumer-oriented equities are going to do well in that environment. If there's going to be a greater loosening in the property sector, again, I think energy and materials companies look really attractive at these levels. So those are the areas that I would be looking to play, as we move deeper into the fourth quarter and a little bit more of a shotgun approach to stimulus comes through.
Would it be the same for American companies that rely on China, or if not rely, then are looking to China for growth, to juice their growth? Do you think people should kind of wait for that stimulus to come and then maybe get in on some of those as well?
I do. Just because things are cheap doesn't mean they can't get cheaper. So I think as investors continue to be disappointed, I think that those companies that are highly tied to Chinese economic activity are going to lag. But again, you don't want to wait on the sidelines too long because China can move very aggressively in a short period of time, given just the top-down leadership that you have in that country. So again, they haven't come to that full realization that the old playbook is dead, but I think they eventually will.
So if not China, then right now, for some investors, is it the other major economy that was set to be it was 1 and 2, China and India, for the most growth that we were set to see this year? Does that naturally pivot attention to India then?
Yeah, I think Indian equities could look like an attractive opportunity if you didn't want to wait on the sidelines for 3 or 4 months at the moment. But again, I do think that there are going to be opportunities that do present themselves. I think investors just need to be a little bit patient. After the strong rally coming into 2023 for Chinese equities, you're basically given that back. But they're very cheap on a relative basis. And I think when you do get that full throttle stimulus, I think emerging markets, more broadly speaking, are going to be attractive, given the fact that most of those emerging markets and their central banks have already dealt with inflation. They're in the position where they can actually start to cut rates and provide some stimulus to their economies.
All right, Jeff, good to see you. Thanks for coming to the studio. Jeff Schultz is ClearBridge Investments Head of Economic and Market Strategy. Thank you.
Thank you.
Now let's talk for a moment about the IPO market, specifically SoftBank's ARM, which is now looking at a valuation of more than $52 billion in its much anticipated listing. It's the so-called crown jewel of the tech conglomerate's empire. It's offering 95.5 million American depositary shares from $47 to $51 a piece. Remember, SoftBank bought ARM for $32 billion in 2016. It's still going to own over 90% of the company when all of this is said and done. All of this said, however, This IPO is a lot smaller than it had been planned before. So what they're planning to raise here is as much as $4.87 billion. It could value the company at about $54.5 billion, as we talked about at the top end. Before, the discussion was to perhaps raise 8 to 10 billion. Right. So now looking at closer to $5 billion indicates something about maybe the demand or lack thereof for those SoftBank shares.
Yeah, and it's going to be an interesting roadshow too, which starts off today, and we saw that release come across this morning. One of the huge things, as a reminder, you've got companies like AMD, Apple, Google or Alphabet, Intel, MediaTek, all of these companies, even NVIDIA and Samsung, that are some of the kind of joint or indirect indicators of interest, at least in purchasing about $735 million worth of the American depository shares in this company. And so there's been a ton of focus just around this IPO and whether or not it will actually kick off some of the other unicorn or decacorns that are still waiting on the sidelines, like an Instacart, that are wanting to, or at least kind of evaluating what the public markets or the reception into the public markets for some of these mega kind of unicorns or mythical creatures out there, however you want to look at them, whether or not they can make some type of positive foray into the market, especially given the last IPO wave that we saw in 2021, large majority or a certain consortium of those really were just the SPAC craze. And then after that, you had the SPACs really sputter thereafter. And so now the environment, not just only in the equity markets and the volatility that we've seen, but also in just the amount of raise that's actually going to come forward, have largely been in question, which is why many of these companies have stayed on the sidelines for this long.
Right. I think we need to come up with a new word. They're too common to be unicorns. Zebras?
Well, no. Unicorn
Zebras are more common than zebras.
Okay, so
zebras are more common than unicorns.
The commonality should make them just like a more regular animal.
They were called unicorns because they were so rare. A privately held company with a valuation of $1 billion or more.
Yes.
Now there are a plethora of those companies.
Yes.
So they're not really rare as a unicorn anymore.
Giraffes are getting more rare. Yep. Giraffes, folks. All your markets
but not as rare as unicorns. In any case, but to your point, the lack of being able to raise as much as previously estimated, I'm sure that these other companies are going to be watching not just how much they're raising, but how they trade in their early days.
And it's a larger question, too, for some of the investors that have either taken place in early rounds for these companies or even later rounds. There was a company in Hugging Face that we were just talking to, another company that has some of these same investors in its Series D round, where you're thinking about, okay, even as these investments are being made, there are some that need to start rolling off. And this is certainly one of them, as SoftBank's looking to cash in, as well as many of the other investors over the years. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Coming up, you know Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's Next.
Let's get to some movers we are watching ahead of the opening bell today. Airbnb and Blackstone are on the list after it was announced the two companies would be joining the S&P 500 on September 18th. They'll replace Lincoln National and Newell Brands. Why is this important? Well, in the case of Blackstone, quite interesting. This is the first alternative asset manager to join the S&P 500. So a little bit of a benchmark, if you will, there. What had prevented the company from going in to the S&P previously is it has a dual share structure, and Standard & Poor's has sort of changed its rules around whether companies like that can be allowed in. So it was predicted that Blackstone was a likely contender, and indeed it is going to be joining the index.
Yeah, absolutely. And on the other side of this, you mentioned Airbnb, a company who we've had the opportunity to speak with here on Yahoo Finance many times over the course of this year. Brian Chesky joining us and really giving us kind of their vision about how they're adding on new hosts to the platform, trying to make sure that people have the ability to monetize more of their living environment. If you saw the first page or the cover of their second quarter release, you'll recognize that Barbie pink from being able to see it either in theaters or just reading through some financial metrics. But at the end of the day, I think for an Airbnb, it really is a signal of how much not only this company has grown up, maintained a lot of investor sentiment over the years, but also how it can be now one of the core travel plays that investors continue to consider. Just taking a look at the move over the past 5 days here, and it's been an interesting past 3 months and year for Airbnb, as well as many of the travel players who have continued to cite that shift to services spending, especially in the experience economy right now.
On the flip side, there's a new law that goes into effect today in New York City that is going to dramatically change Airbnb's exposure in New York. It's a new short-term rental law that is going to put a lot of curbs on whether people can sublet out their apartments through Airbnb. They have to live in the apartment, I believe, at least some of the time. That's one of the regulations. So we're going to see a big drop in listings, most likely, for Airbnbs in New York. Perhaps this has already been priced into the shares. We knew this was going into effect, but it is something to keep an eye on in this city, especially since we have seen a smattering of cities enact laws like this. So will there be more? Again, there hasn't been that much of a hit to the stock because of this, at least not recently, but something to keep an eye on.
Yeah, I'm taking a look at Expedia shares as well on that same note, down by about 0.7% here pre-market. But of course, that company made some key strategic acquisitions in some of the Airbnb competitors, namely Vrbo as well. And so we'll see how that law takes them. I got some neighbors that I think are renting out their place. I'm not going to snitch on them. Which unit? Who knows?
But I guess overbalancing that is this idea that they're being added to the S&P. You have an enormous amount of money that is benchmarked to the S&P 500 in ETFs, in index funds, et cetera. So these stocks get automatically added to those holdings in advance of a move like this. So that's why you see them move higher when something like this happens. Well, we're coming up on the opening bell on Wall Street, aren't we, on this Tuesday that feels like a Monday, of course, because of the market closure yesterday for the Labor Day holiday. So it really feels like we are getting into fall in earnest here. Back to school happening this week for many, already happened for a lot of folks as well. But as we get underway here in this September, that, as we've said, seasonally tends to be weak for markets. Let's do a quick check, sponsored by Tasty Trade. All three major averages are opening this first well, it's not the first trading day of the month, but it is the first trading day post-Labor Day. And we've got the Nasdaq leading losses off by about 0.25%. But the Dow, not much change, actually peaking a little bit higher. Brad Smith, you're over at the Interactive.
Yeah.
Heavy sighs over there.
I mean, it's still hot out here. We're talking about fall. I mean, I'm sweating more out here than
it's not technically fall,
cat in a room
right?
full of rocking chairs.
The season hasn't actually changed yet. It's just, like, because of back to school, it feels like it, but temperature-wise, we've got a heat wave here in New York City. So.
Yeah. I mean, you could send the kids to school in some, bathing suits if you want to. They'd probably be better equipped. Anyway, taking a look at how the stocks are doing this morning. Don't do that to your kids, by the way. Dow Jones Industrial Average, you're seeing the flat just barely to the upside. Hyper oscillating in between gains and losses here. So we'll see if that makes up its mind as we move on throughout the rest of today's session. It'll have to by 4. Nasdaq Composite, you're seeing that flat just barely to the downside. That's lower by about 0.3%. We're going to populate this chart for you folks just to give you a look at how we're doing. We'll say over the past 30 days. Why not? Past month, S&P 500 higher by about 0.8%, flat just barely to the downside here out of the gate this morning. And then additionally, since we're talking about the S&P 500, let's take a look at those 11 sectors. Got them lit up for you here on the screen in some festive green and red. XLE, energy, yeah, we're going to talk about that for a hot second. That's up by about 0.7%. Of course, a lot of movements in the oil markets today. So we're going to keep a close eye on XLE. That's leading the pack. Looks like we have more laggards than gainers, though, and utilities is the biggest laggard of them all as of right now. It's down by about 0.3%. You've also got technology that's moving around in that same ballpark. That's down by about 0.3%. Speaking of technology, take a look at the Nasdaq 100 here this morning. A lot of red here, it seems like, on the screen, and that's indeed correct. We've got more laggards than leaders here. Pinduoduo is the worst of them all. As of right now, it's down by about 3%. However, leading the pack, yeah, the aforementioned Airbnb, which makes its debut into the S&P 500 September 18th, I believe is the date that takes place. Netflix is also moving around in there. That's up by about 1%. So keep a close eye on shares of NFLX.
Oh, and look at that. Illumina is the worst performer there in the Nasdaq 100. The company getting a new CEO today after Francis D'Souza, the prior CEO, stepped down and was under attack by activists. Right. And just appointed that new CEO, but investors not too happy about it, it looks like.
Yeah, year to date, shares down by about 19%. Investors wouldn't be happy with that either here. So we will continue to keep a close eye on all of these movers for you here. And then just lastly, here's a look at the Dow 30 components here, just as we ride out with a look at this heat map and overall Wi-Fi interactive market check.
Thanks, Brad. I was just looking up who the new CEO of Illumina was because it was escaping me. Agilent Technologies' Jacob Thaysen will be the next CEO of Illumina after Francis D'Souza left earlier this year. September 25th is when that is effective. Moving on to another mover, though, shares of Manchester United plunging today after the Glazer family will reportedly be taking the team off the market after failing to reach an agreement for their asking price. That's according to the Mail on Sunday. That has not been confirmed yet. There's no public announcement on the part of the Glazer family. But boy, this has been quite a saga because we saw the shares spike last November on speculation that the club was up for sale. Since then, there have been so many back and forth reports about potential bidders. Was it going to be sold? Was it not going to be sold? According to the Mail on Sunday, the Glazer family is trying to get £10 billion for the club and reportedly has not gotten that. And so that's why they're considering taking it off the market for now. I mean,
you think about the families and sports ownership more broadly, and this has been one of the more storied kind of franchises as a whole, but in the ownership that does not have a good relationship with its fan base. The fan base is upset about how much get everything from how much they're charged in concessions to, just the relationship with the family. And I think this one is now becoming kind of the poster child or poster family for how not to engage with fans. For a while, it was Dan Snyder over at the Washington Commanders, but we've moved on to a different football type of club here.
Yes, indeed we have. And this one, unlike the U.S. ones, is publicly traded,
exactly.
So we see it playing out in terms of the stock price. According to this report in the Mail on Sunday, it might be put back on the market in 2025 when we see a FIFA World Cup expansion in the number of teams that participate in the World Cup, and then maybe there's some speculation about the viewing rights for the club. Maybe that would go up and make it more valuable, et cetera, et cetera. Again, this hasn't been confirmed, and there's been a lot of back and forth in this, but the shares today are reflecting this report.
Yeah, big time. We're also watching Warner Brothers Discovery after the media giant has updated its 2023 earnings forecast, now expecting a $300 million to $500 million hit from the ongoing Hollywood strikes. Yahoo Finance's Alexandra Canal is here with the details. Ali, what do we know about this one this morning?
Yeah, so this is from a new regulatory filing that WBD released this morning, and they are lowering that full-year EBITDA forecast to $10.5 billion to $11 billion. That's down from the prior lower-end range of $11 to $11.5 billion, and as you mentioned, signals that hit between $300 to $500 million. WBD said this is, quote, predominantly due to the impact of the strikes. We know the writer strike is now past the 5-month mark. The actor strike is about to enter month 2. David Zaslav, he is the CEO of Warner Brothers Discovery. He has been very active in these ongoing negotiations, but we've seen talk talks hit a recent stalemate after the Writers Guild said that the studio's counterproposal did not even come close to satisfying all of those demands. And it's interesting because in the second quarter earnings report, WBD said they expected to be back to work in early September. Here we are, early September. Clearly that's not the case. So again, in this regulatory filing, they did update that expectation as well, writing, quote, while WBD is hopeful that these strikes will be resolved soon, it cannot predict when the strikes will ultimately end. With both guilds still on strike today, the company now assumes the financial impact to WBD of these strikes will persist through the end of 2023. And we've already seen that ripple effect on our TV screens, in addition to the box office. Dune 2, a highly anticipated sequel from Warner Brothers that was delayed from November of this year to March of next year. That's going to be a significant hit to the box office. But while earnings have been, will be diluted from these strikes, free cash flow is expected to improve. The company did raise its free cash flow expectations for the full year to at least $5 billion. And basically, because you're not investing in new projects, you have more cash on hand.
So it seems like this was not a huge surprise to investors. As you said, the company has previously talked about what might be the consequences of this. The shares are not taking that much of a hit. So I guess the question is, if you're the union and you're looking at this, you want the company to feel more pain, right? I mean, if you think about that calculation, right? The union wants the studios to be in a tough enough spot that they are willing to make concessions and vice versa. I mean, basically both sides are waiting each other out because the actors and writers are not collecting paychecks right now. And we think of the big Hollywood stars, but there are a lot of just working actors and writers who do depend on the paycheck. So you've got the two sides sort of at this standstill as they wait each other out, it feels.
And that's the issue. I have read a lot out there that says the actors and writers now have the power right now, and they can wait as long as they want. But as you mentioned, there's a lot of pain to be felt. These are people's livelihoods. And, we've recently heard from the Milken Institute, they anticipated a $5 billion hit to the U.S. economy, and that's primarily due to lost wages. We heard the strikes come up in the jobs report on Friday for the first time. 17,000 jobs lost in that production realm. You have to think that there's going to be more pain to come on this side. But as you're saying, it's sort of which side is going to crack first. And, we're hearing from these studios now that they're lowering their forecasts. They're saying that they're going to see a hit to profits. How long can that last, and how long can the writers and the actors hold out? That's the big question.
And then when we were talking about last week as well, whether or not they start to kind of form a different type of consortium among studios and keep Netflix out was one of the...
That was a proposal.
One of the proposals as well. I mean, is there any movement on that front, or does it seem like everyone's still willing to make sure that they've got some type of representation at the table?
Well, Ted Sarandos, the co-CEO of Netflix, he was present at that meeting, at those negotiations, along with Disney CEO Bob Iger, WBD CEO David Zaslav. So it seems like Ted won't want to break away. I do think he wants to be involved in the negotiation process. And you have to remember, it wasn't too long ago that Netflix was fighting for that seat at the table. They wanted to be recognized like a Disney or a WBD as a real, tangible studio. So I would be surprised if they broke away. But, it's a dog-eat-dog world out there. And if you're racing for content and if they're able to get a deal done that the others can't, who knows? Stranger things have happened.
So. Stranger things, huh?
Yeah, exactly. No pun intended.
Thanks, Allie. Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Yahoo Finance.
Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Halley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's next. Stocks closed out August in rally mode after falling for much of the month. After a choppy month of August, stocks are now gearing up for what is historically the worst month of the year for the S&P 500. Will September be as bad as expected? That's the big question here. Here with more and a crystal ball, live from the New York Stock Exchange, Jared Blickery. Hey, Jared.
Hey, my crystal ball only extends backwards in time, but it does help give us a little bit of a glimmer of what might be on the horizon here. So let's take a look at the S&P 500 on the Wi-Fi Interactive. This is performance by month, and I have September, October, November, December, each represented as a different line going back to 1960. What stands out is September. That's this purple line down here. If you had $1,000 and put that money into the market only in September's going back to 1960, you would now have about $600, or it would be worth 40% less. Then you compare that to October. That's that cyan line up here. By the way, October has quite a big number of dips here, and that's because October is primetime crash season. I've been talking about that as well. But then November and December, two of the better months of the year, those tend to end on highs, and December specifically usually sees that Santa Claus effect. Not to get too far ahead of ourselves here, I just want to show what the VIX usually does. I mentioned primetime crash season. Well, we usually see the VIX peaking in October. That's this biggest purple bar here. That is the average VIX going back to 1990. That was the inception of calculation. The cyan line is what's happening this year. So if we were to trace out that pattern, well, we might expect a few more hiccups into October, but not necessarily a crash, because one of the things I was looking at when I was parsing the statistics here is that when we have a really good year through July, but then we fall off in August, the S&P 500 usually does pretty well in that September, October, November, and December. And here are these stats that are showing that. January through July, green, August, red, and then September, 82% positive. I only have 11 instances going back in time, but October, 64%, that's 7 out of 11. Then it gets better in November, 73% positive, and December, 91% positive. So it could be, for whatever reason, and I noted this when you were talking before, Julie, about how some of these crash years tend to drop off. Well, as it stands, crash years tend to drop off my radar when we have these big outside gains through July and we see these declines in August. So interesting combination there. But of course, we'll have to see how the future is exactly written, I guess, in the future.
Yeah, we'll have to wait. Unfortunately, that's the thing about the future. Jared, one of the other dynamics, of course, that we watch in this August to September transition is people coming back from summer vacations, more trading volumes. What can you tell us about what to watch there?
It's no secret that the summer sees lower liquidity, and that's simply because of an absence of traders. We have a lot of traders. The old adage on Wall Street is sell in May and go away. I like to say hedge in May and go away, because that more accurately describes what some of the larger players like to do in the market. They don't want to tend to their positions and nurse them day after day over those summer months, so they largely put them as much as they can on autopilot. And then we see a resurgence of liquidity in September when people have decided, for whatever reasons, historically, that September is a month when you rejigger your positions, and so we find a return of liquidity in the month of September. I have a chart of this on the Wi-Fi Interactive. This is NYSE volume seasonality by month. Here we have January at the far left edge, and then January again at the far right edge, so we can see how the December-January transition goes. But you can see we are trending lower, typically from about March into the beginning of September, and then we see this big increase here, and we kind of stay at this higher volume level until we drop off precipitously in December, but that's simply because of more vacation time. So I would expect, and this has to do with that VIX seasonality that I was showing here too, because we have enhanced liquidity in September, that's when we're more likely to see a market crash, a major market dislocation as traders change their bets on the market. I got one more chart here on the Wi-Fi Interactive. This is Treasury liquidity. So this is liquidity in the bond market, not the stock market. This usually gets worse in August. That was, I just pulled this out of my files here, but you can see liquidity improves in September. This improvement here we can see for going back to, I believe, 2000. And then October, a little bit better, and then Treasury market liquidity itself dies off into November, December. Just want to close here by telling what we have done lately, so not just looking at 30, 40, 50 years in the past, but what we have done lately. Here is the VIX. We are coming off some very low levels, Friday. Was that a game changer event? I don't think so, but really interesting to see. We do have a little bit of an uptick in volatility there. Looking at the 10-year T-note yield, that is up about 6 basis points as well, firmly above 4%, so maybe challenging those highs. I think September is going to be a really interesting mark to watch here. What do you guys say?
I say I'm very glad that you're here to take us through it all, Jared. Appreciate it. We'll count on you to continue to do so. Thank you. In a new Wall Street Journal survey, 73% of voters say they feel President Biden is too old to seek a second term. 47% of voters felt the same way about Trump, though the candidates are only 3 years apart. With more on what this latest polling tells us ahead of the 2024 election, Yahoo Finance's Rick Newman, and also a lot of findings in there about Americans' perception of Bidenomics, right, of his handling of the U.S. economy, Rick.
Yeah, and it's all pretty familiar. I mean, it reinforces the challenges Biden faces as he tries to get reelected here. Weak numbers in terms of the economy. His overall approval rating is around under 40%, and in the aggregate of polls, it's around 41, 42%. Biden is not getting credit for the good things that are happening in the economy. The only category in this poll where his approval rating and his disapproval rating are more or less the same is on job creation. And there has been a lot of job creation under Biden, but on the economy overall, he's underwater, low approval rating on that. And, the biggest problem is inflation. That comes out in this poll, and that has just been a consistent problem for Biden. So the inflation rate is obviously down. It peaked at 9% last year, and it's now at, I think, 3.2%. But people don't seem to be feeling a lot of relief. And that could be because all the price increases that we've seen during the last 2 or 3 years, those are still there. We're just getting a lower rate of price increases, but we're not getting deflation overall where prices are actually falling. So this is going to be a persistent problem for Biden. And I think this might gradually improve during the next year, assuming the inflation rate continues to come down. But I'm not sure it's going to disappear as a problem for him.
All right. Well, inflation might come down, but ages don't. Also here, Rick, while we've got you, North Korean leader Kim Jong-un set to meet Vladimir Putin. What can you tell us there?
It seems like an act of desperation for Russia. I mean, one of the reasons that they are getting together apparently is so that Russia can buy ammunition from North Korea. So that tells you it's not getting ammunition from China. It's not getting what it needs from other partners. And a lot of the North Korean ammunition dates to the Soviet era, and who knows how reliable it is. So this could be a problem. I mean, we've got interesting things happening in these alliances. We just had President Biden meeting with the leaders of Japan and South Korea. So there's a kind of a rapprochement between Japan and South Korea, an alliance forming there. So Russia may be trying to offset that to some extent. So lots of things to watch here. I mean, we have a lot of change happening in geopolitics that is going to affect things for a long time. So keep your eye on these meetings.
All right, certainly will. Yahoo Finance's own Rick Newman, thanks so much for bringing that to our attention.
Bye, guys.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is What's Next with Samsung.
You can put it in the water.
That's pretty gnarly.
Water.
This is the heart and soul of Astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series, Next.
In August, the United Auto Workers Union overwhelmingly voted to stop production if demands on pay and benefits were not met. Facing the calls are the big three automakers, General Motors, Ford, and Stellantis. Negotiators are discussing 4-year contracts for around 150,000 hourly workers, and specifically, the UAW is demanding a 46% pay raise and a 32-hour week with 40 hours of pay. The union's current contract expires at just before midnight on September 14th, so we're coming up to it. President Biden, often labeled the most pro-union president ever, yesterday downplayed the threat of a strike, saying he thinks any kind of action is unlikely to happen. Joining us now is Greg Migliore, Autoblog's editor-in-chief. And Greg, I know you've been watching this very closely as well. Put this in perspective for us, the likelihood of a strike, how this compares to past actions, because we've got new leadership at the UAW. Give us sort of the what we need to know going into this deadline.
Yeah, hey, good morning, everybody. I would agree with the president that I think the likelihood of a strike is still relatively low. That being said, this is the most aggressive, I would say, bargaining tactics we've seen from the UAW in quite some time. They last struck in 2019 against General Motors, and that was, I believe, it was a 40-day strike that cost the company billions of dollars. So it's certainly not in the best interest of the Detroit Three to have to weather another strike. Again, the broader economic impact, even for a relatively short strike, would get into the billions. So they certainly want it's in everyone's best interest, if you will, to try to come to an agreement before that September 14th deadline.
Greg, it sounds like the auto manufacturers, at least GM and Ford, are confident that they'll be able to avert a strike. GM saying in their most recent earnings call that we have a long history of negotiating fair contracts with both unions that reward employees, support long-term success of the business. Goal this time, no different. But if they do not see a similar kind of success as they have seen in the past, this time, what type of hit could we be talking about in terms of the prioritization of certain production standards and goals that they had set forth?
Well, the way the General Motors, Ford, and Stellantis, which was Chrysler, the way their manufacturing footprints are set up, everything is very interrelated. So the UAW could choose a couple of different paths. They could do like a full national strike, or they could do a targeted strike, which could be just as effective. If you shut down one or two very specific plants that make a specific part, that's essentially as good as shutting down the whole company. So we could see a couple of different paths here. I think it's also worth noting that the UAW is under new leadership. Shawn Fain, he's been in office a relatively short time, and he's taken definitely a more outspoken, some might say argumentative approach. But I think UAW leadership also sees opportunity. You have a president in the Oval Office who is the most pro-union, as he says, in generations. You have a highly publicized writers' strike going on in Hollywood. I think the mood for labor in this country is definitely swinging to a climate where there would be some support for workers. So I think the UAW president senses some opportunity here, and I think what he's doing is leveraging it. I wouldn't necessarily call it saber rattling. But I think he's definitely making a lot of demands, which is good negotiation, in an attempt to get probably enough part of what he's asking for. Do I think they're going to get a 46% wage increase? I think that's probably unlikely, but I think they could definitely get some significant concessions from the Detroit Three, which would certainly be a victory for the union.
Greg, it's the sort of points that you bring up are really interesting. I'm really fascinated at this moment in time in terms of union power in the U.S. Because on the one hand, it seems as though the tight labor market has given more power to unions. On the other hand, membership is down in unions writ large, right? So how do we put the UAW of today in context versus the UAW of the past?
That's an interesting point. I covered the 2019 General Motors strike, and at the moment, it almost seemed like you're thinking, well, a strike, that's like from the 1930s or the 1970s, but it was very much a real strike that cost GM billions of dollars. So, cards on the table. If that happens again, it will be real. There will be an impact. It will be a pretty big economic impact, if you will. One of the reasons labor and union membership is down is companies, many of them, simply just have fewer workers. With manufacturing pivoting to more automated roles, you just don't need as many people as you used to. So I think that's one of the reasons. Generally speaking, for all three of the Detroit three, they're as unionized by percentage as they've ever been. Some other industries, it's not the case. But I think at this point, the UAW knows it has a fairly strong hand, and they want to play it. Again, like the president said, I don't think they'll strike until it happens. And I think it's it's an interesting deadline, September 14th. That's one day after the Detroit Auto Show opens. So it's going to be a very interesting week next week here in Detroit.
Yeah, indeed. Greg, when we think about the electric vehicle ambitions that all of these companies have announced or set forth as well, how does that change the negotiating pathway, the structure, and what's even being asked for by the UAW?
So I don't think it has to. Electric vehicles are cars at their very basic nature. It's just simply a different method of getting from point A to point B. I don't think it necessarily has to change the way negotiations go. Certainly some of the factories will be retooled to build electric vehicles, but at the end of the day, it does take a lot of people to build a car. So it does seem like you could maybe get into a little bit of the political realm, if you will, as far as EVs versus internal combustion vehicles. But at this point, I think, end of the day, it still takes a factory with a lot of people in it to build a car, whether it's powered by electricity or gas, or it's a hybrid or something else.
Greg Migliore, who is the editor-in-chief of Autoblog. Greg, thanks so much for taking the time and really helping us break this down even further.
Thank you.
Absolutely. Everyone, we've got your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Coming up, there's Yahoo Finance's tech editor, slack-jawed and spinning like a pinwheel. Does Dan Halley make it home, though? That's the big question. And does he even make it out of the town square? Find out. Yahoo Finance is next. Hey, welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the start of today's trading session. So let's take a look at how stocks are moving right now. Stocks are lower to start off this holiday abbreviated week. Investors could be in for a challenging few weeks ahead, with September historically the weakest month for equities. There's also plenty of data on the docket ahead of the Fed's September policy meeting.
And on an individual basis, we're watching shares of Lowe's this morning. Bernstein upgrading the home improvement chain to outperform from market perform. Analyst there, Dean Rosenblum, saying in a note he now sees an influx of positive trends that could expand the company's margins in the next 2 years. He added that Lowe's growth could outpace that of competitor Home Depot, and the shares not getting the benefit here this morning.
Yeah, we're also watching Oracle after Barclays upgraded the stock from equal weight to overweight and raised its price target to $150, citing the company's multi-year growth story. In a note, analysts saying that the giant's cloud infrastructure in this business, partly fueled by emerging AI opportunities, will be a key to the overall story.
And shares of Illumina are on the move as well. They are trading lower by about 4% after the company announced former Agilent Senior Vice President Jacob Thaysen will take the helm as its new CEO. That's effective September 25th. The move comes months after a bout of leadership turmoil. Previous CEO Francis D'Souza stepping down in June, just weeks after activist investor Carl Icahn tried and failed to oust him from the top spot. Well, the first holiday-shortened week of September will bring several economic data points as the Federal Reserve's next interest rate decision quickly approaches. With more on what's ahead this week, as always, we are joined by Yahoo Finance's Josh Schaefer with the calendar action.
Yes, Julie, and it is admittedly not our most exciting calendar. This might actually be, I like to rate the calendar, this might be one of our more boring calendars we have all year, candidly. But what we do have is a couple little data points, right? We got a couple things to get excited about. Tomorrow, the Federal Reserve's Beige Book will be out, and that gives us a look at the state of the economies from the different areas where the Federal Reserve banks are throughout the country. That'll be an interesting thing to watch to see what we hear about economic growth or perhaps cooling of economic growth in some areas. And another thing I think will come into focus a little bit more over the next couple months now is initial jobless claims every Thursday. That's a weekly release we get. And that number has not moved a lot over the last couple months, meaning there hasn't been more people filing for jobless claims. Interesting to see that with the unemployment rate up. What that really told us on Friday was just that there are more people coming into the labor market, not necessarily more people becoming unemployed. It's more people that were looking for work. So I think that Thursday release is going to become something people are watching a bit more moving forward now. And then we do still have some earnings this week, not an overly exciting earnings week, but a couple things to watch if we take a look at that side of the calendar with what we have for earnings. You'll see that there's a couple companies reporting. Key companies I'm watching really on Wednesday here. I think it could be fun to just see how C3 AI and GameStop move on earnings. Those we know are two meme-like trades. C3 AI really driven by that AI trade. GameStop has been a meme mover in the past. Do we still have any market exuberance left after we sort of cooled off in August? I think we might get a better look at that on Wednesday. And then on Friday, we have Kroger, which will be interesting to hear about that potential merger, and then also just what's happening with groceries, what's happening with inflation. So a couple key points to look at, but really I think we're starting to get to the point in September, guys, where we're waiting to hear more before that Fed meeting, and we're not going to get that until an inflation print next week.
Yeah, sounds like whether you like games, groceries, or overpriced furniture and hardware.
There's always a little something for everyone.
There's
Brad.
something for you this week, yeah. Thanks so much, Yahoo Finance's own Josh Schaefer. Appreciate it. Well, Brent crude hit $90 a barrel for the first time since November after Saudi Arabia and Russia extended supply cuts. Yahoo Finance's Inez Foray here with the story. Hey, Inez.
Yeah, a significant move with what we've seen with oil, Brent crude, and also WTI up more than 1.5% right now. And this is after Saudi Arabia said that it was going to extend its voluntary cuts through until December. That is a 3-month extension. This is a 1 million barrel a day cut until December. And the length of that extension is a bit of a surprise when it comes to traders, because it was expected that Saudi Arabia would extend its cuts, but to extend them by 3 months, that is a bit of a surprise. And also Saudi Arabia saying that it will review this decision on a monthly basis. But nonetheless, the message is very clear that Saudi Arabia wants to keep a floor on prices or keep prices elevated however however you want to take a look at it. And even one analyst saying that price over volume is the strategy here, because Saudi Arabia has very ambitious plans for the coming years. It's Vision 2030 plans for projects that need to be funded, and they want to keep these prices elevated. As far as Russia is concerned, Russia said it will be curbing its exports by 300,000 barrels per day through the end of the year. So if we take a look at our Wi-Fi Interactive, you saw year to date, you've got WTI that's up 13%, Brent crude that's up 9%. But really the big move that we have been watching is from those lows in June, at the end of June, we have seen Brent and WTI up about 25% since those lows. Not a good sign when it comes to inflation, guys.
Yeah, perhaps not. Ines Ferre, thank you so much. And that's the perfect setup for our next guest. We're talking oil. Saudi Arabia and Russia unveiling the fresh extension to their voluntary supply cuts this morning. That was the latest catalyst for those oil prices. With us now to discuss further is Tamar Essner, Vectis Energy Partners Principal. Thanks for being here, Tamar. So as we look at the dynamics here in the oil market, first let's start with that extension of the production cuts on the part of Saudi Arabia in particular. How important is that, and how much it's extended to December? How much further could we see it extended?
Hi, Julie. Thanks for having me. I think it's significant because Saudi is going at this unilaterally. Obviously, we've seen that your prior reporter reported about Russia extending through September as well. That's all part of Russia's seasonal plan, as they always come off a little bit in September, and then that production comes back in October and November. And we think that Russia is very much incentivized to pump as much as they can right now and find alternative markets to Western buyers, because they need all the revenue that they can get as they prosecute this war in Ukraine. And they've really lost market share on gas. So they have to find it on oil. At the same time, we've seen that Venezuela and Iran have been pumping more than expected, and other countries within OPEC, which are not part of this unilateral production cut, and that historically have had much more volatile production outlooks, like Nigeria and Iraq and Libya, they've actually been quite stable with their production with their production flows. So I think that Saudi Arabia might have a little bit of difficulty because their production cuts are going to be offset by higher production from other countries within OPEC. That being said, it is really significant because they are trying to address the skepticism of the market. The rally since the lows in June has really been an unloved rally, and they're really trying to convince investors that, hey, just because there's macro concerns from an interest rate perspective and from negative headlines about China, we are here and we are fully committed. So I think it's really meant to address the psychology more than the fundamentals.
And Tamar, you mentioned China and the fact that the economic woes there are not actually reducing oil demand, but perhaps it's redirecting it. How would you evaluate that?
Sure, great question. So obviously, anytime China sneezes, basically, oil gets a cold or even the flu. The market's so sensitive to China. And the negative headlines about the property sector there have somewhat dampened petrochemical demand for oil. But post-COVID and post the lockdowns, mobility demand has more than offset that. So people are flying, they're driving, they're going to reconnect with families. And so demand in China has really been good. I think that what the market has starting to appreciate now is that while Saudi Arabia is a swing producer, China is basically a swing buyer. So they have huge inventories, huge storage. And so they basically can buy as much as they want when prices are attractive to them, as they definitely were earlier this year. And now that prices are starting to creep up higher with these Saudi unilateral cuts, China can take the foot off their gas, and they don't have to buy as much because they've built up their inventory. So I think that their demand is good, but it may start to cool off a little bit in the coming months because they have inventory to work off of.
So all said and done, where do you think oil prices go before the end of the year?
We think that the oil prices, at least for WTI, have found a decent sweet spot here, a range between on the low 75 and up to 90, maybe even a little bit past 90. But as I said, I think as China takes the foot off of the gas of their purchases and that other OPEC countries continue to supply the market, there's a bit of a balance here. Obviously, this is barring any developments on the geopolitical stage, and that's a big if. Certainly, there's a lot of opportunity for things to change with this war in Ukraine as things heat up with China. So there's a lot of big outliers and big wild cards, but the base case is that oil is sort of in a nice range here between now and the end of the year.
So can inflation then abate if oil doesn't moderate lower from this range?
We expect inflation is sort of here to stay higher for longer, and even with interest rates. I think people had thought that higher interest rates would be supportive of the dollar, and a stronger dollar would put somewhat downward pressure on oil prices. But we've seen that higher interest rates has actually made drilling more expensive, and it's made storage for oil more expensive. So it's actually provided somewhat of an upward support for oil prices. So we think that the economies around the world, particularly the developed economies, have become much more insulated from higher oil prices. So even though nobody wants to pay more at the pump, people are. And so the market and the U.S. economy, which is the most important driver, the U.S. economy is the most important driver for global gasoline, it's holding up well. And so demand is sort of steady as she goes, despite these higher prices and despite higher inflation.
Tamar, let's take this all back also to the energy producers, right? And I'm curious if we're going to see prices sort of hover in the sweet spot. The implication is that could be good potentially for energy companies and energy stocks. Is that the conclusion we should be drawing?
I think so. I think energy has been a sort of an unloved sector, even with the recent outperformance in those stocks. It's still not hasn't seen broad investor participation. So we continue to like the sector from an equity perspective. And the interesting thing is that even with higher prices, companies, management teams, and at least for U.S. companies, are really under a tight leash from their investors, and they don't really have much leeway to grow production more. So we think that the production outlook in the U.S. is strong between now and the end of the year, but we don't anticipate a huge amount of continued growth in the U.S. market. And that's actually net positive for the companies because it sort of helps keep prices supported.
Tamar Essner, Vectus Energy Partners Principal. Thank you so much, Tamar, for your perspective on all of this. Appreciate it.
Thanks, Julie.
We got much more coming up. You're watching Yahoo Finance.
Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. You'll find out when Yahoo Finance is next.
It's almost an hour into trading now. Let's start checking the market, sponsored by Tasty Trade, and take a look at what is on the move in terms of major averages. We do have declines across the board here, with the Nasdaq leading them, although now it's neck and neck with the S&P 500. The Dow also off about 0.25%. So a bit of a negative tone to kick off the back-to-school season here. Regulators unveiling a new set of bank rules last week that would require lenders with at least $100 billion in assets to issue enough long-term debt to absorb losses in case of a potential seizure. The proposal from the Federal Deposit Insurance Corporation, or FDIC, is designed to prevent the systemic worries that roiled the U.S. banking system earlier this year when several mid-sized lenders like Silicon Valley Bank and Signature Bank collapsed. Our next guest says the regulatory overhaul for large and mid-sized banks could lead to stronger pressure for those banks to merge in the coming years, leaving smaller banks arguably less stable. Joining us now, John Heltman, Washington Bureau Chief for American Banker. And John, as you write, this could create sort of a two-tiered system. I mean, I guess you could say we already sort of have one, but this would make it even more acute. Walk us through how that would happen.
Thank you, Julie. So this is a little bit of a thought exercise, right? So we have the rules that were sort of proposed last week from the FDIC, the Fed, the OCC. We also last month had capital rules that were proposed by the same regulators that would effectively raise capital, especially for the largest banks. And there's still more to come. There's a Community Reinvestment Act overhaul that will probably end up costing more money for banks. The CFPB has been working on rules on late fees, thus restricting late fee income, and on data collection and some other things. And in addition to all of this, we're in a landscape where interest rates are making kind of interest rate margins tighter, loan demand is lower, and because loan demand is lower and there are all these underwater assets or underwater treasuries that led to the demise of Silicon Valley Bank and others earlier this year, it's just making things a little tighter for banks in a general way. And the banks that are best situated to weather that tightness are larger banks, right? And by expanding these rules to include a broader swath of banks, it's going to apply that same kind of economic pressure to a bigger group of banks in the kind of mid-size to large, range. And that pressure will lead many of those banks to say, well, we'd probably be better off if we had a bigger base from which to draw, thus increasing the pressure to merge. I'll also note.
Sorry, go ahead.
I was just going to say, it's worth noting that all of these rules don't apply to small banks, which represent the majority of all banks in the banking industry, thus creating the kind of two-tiered effect that I described in the piece.
And so the pass-through to credit conditions right now, how much more difficult does it make the environment in credit conditions?
The economic kind of credit condition thing is, I think, largely a outgrowth of interest rate increases. That is by design. You raise interest rates in order to make cash or to make money more expensive, harder to borrow, or more expensive to borrow, thus presumably weeding out maybe more speculative kinds of loan investments, but in general, just making everything kind of cool down. So that effect is sort of happening independently of this regulatory push that we're now experiencing, that is very much informed by the failures from earlier this year. But it does make everything kind of harder, because it means that if you have these kinds of these loans on the books that aren't really competitive in this interest rate environment, it's harder to get new loans that are competitive in this interest rate environment to replace them or to kind of float them a little bit.
John, I know this is sort of a bigger question that we probably don't have time to tackle entirely today, but if there are fewer banks in the United States, is that on balance a bad thing? We have a proliferation of banks, unlike what other countries have seen, but we also have sort of an entrepreneur culture, unlike many other nations. So how do we sort of balance all of that? If the banking sector gets smaller, how do we sort of judge whether that is good or bad?
Is that good or bad? This is very much a matter of debate and a matter of different people come at this from very different perspectives. The United States has, I think, as of right now, something in the order of 4,500 banks, chartered banks. The vast majority of those are small. And the vast majority of those small banks kind of operate in, kind of rural areas or smaller kind of, economic markets where they're kind of like big fish in smaller ponds. And the reason that they're able to sort of survive is because for larger banks, there isn't really enough there to be worth opening a branch or to kind of try to get into those markets. The concern is that so some consolidation kind of makes sense. There aren't 5,000 airlines. There aren't 5,000 burger chains. Like most markets would consider having 5,000 participants or 4,500 participants, not including credit unions, fintechs, and everybody else who's doing many of the same kinds of services that banks perform, or at least have traditionally performed. A little consolidation probably wouldn't be that harmful. And indeed, we used to have like 12,000 banks, 25 years ago or 30 years ago, and it's been gradually decreasing ever since then. Primarily, some of that's for kind of like legal reasons, like they've changed laws that makes it easier for banks to merge, and they have, thus resulting in much bigger banks. Without necessarily saying that consolidation is good or bad, the concern is that if you have consolidation, especially at the smaller end, which in my piece I sort of suggest is likely, because you're going to need more consolidation and more kind of economies of scale in order to compete with a smaller number of bigger players. The risk is that you aren't going to get credit access to these smaller kind of rural entrepreneurial kinds of communities that have come to rely on them for so long.
All right, John Heltman, Washington Bureau Chief for American Banker. John, thanks so much for breaking down this new rule proposal, and we'll see what it looks like between proposal and finalization, as well as you wrote about. Thanks so much.
You bet. Thanks.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Seoul has more Starbucks stores than any city in the world, but Dan Halley isn't looking for a brown sugar shaken espresso. Find out why he's there on Yahoo Finance's next. Last week, a federal appeals court said the SEC must review Grayscale's bid to convert its Bitcoin trust into an ETF. The trust issuer manages the world's largest cryptocurrency fund and first applied for the conversion in October of 2021. The move was seen as a landmark decision and saw Bitcoin and all crypto-related assets rocket. More on this and the future of ETF investment. Rick Edelman, founder of the Digital Assets Council of Financial Professionals, joins us now. Rick, good to have you here with us this morning. First, what was your reaction when you saw this taking place, considering that we've been in a crypto winter? We've seen some of the lust or some of the gravitational pull towards other assets or more risky assets like crypto largely abate over the course of this year.
You're absolutely right. We have been in the crypto winter for far too long, and this is the biggest bull news. This is the most bullish signal that we've had in crypto in years. So it's very exciting. That's why you saw the crypto prices jump 20-25% immediately on the news. But we must not get too excited, too carried away. The court did not order the SEC to approve these ETFs. The court merely said that its rejection of Grayscale's application was inappropriate. They called it unreasonable. They said it was arbitrary and capricious, and that is going to force the SEC to do something about it. But approval is not necessarily what the SEC has to do.
And so does that mean people shouldn't rush out and buy Bitcoin or, for that matter, buy the trust itself in the wake of this decision?
Well, I am bullish about this. I do believe that this will lead to the SEC approving these applications. I am in that camp, but it's not guaranteed. We have to recognize that the SEC has a variety of options at its disposal. It could appeal the ruling. That would take months or years to work its way through the court. It could acquiesce and force Grayscale to refile a brand new application. That would take another year for it to process. It could, frankly, do something that I think nobody is expecting. The SEC could say, well, if the court tells us we can't say yes to futures, but no to the spot, then let's just say no to the futures and pull the futures ETFs off the market. That would be shocking. Nobody's expecting it, and it would be extraordinarily negative for crypto prices if that were to occur.
You know, we had CEO of Grayscale Investments, Michael Sonnenschein, on last week as all of this news was really playing out. And he said that the stage is set for an environment around crypto that we haven't seen before. We've seen a lot of things in crypto. What is still left? I mean, we're talking about utilization. We're talking about actually having an instrument that people, investors, could trade similar to what's already been out in the markets, what's already been available. And so what does the SEC need to see differently in an application or in a review process in order for that to come to full fruition?
Well, there's nothing legitimate that the SEC needs to see. This is simply a vendetta by Gary Gensler. There is no legitimacy or justification for the denial of these ETF applications. I mean, if the SEC can approve 2x inverse funds, if they can approve single stock ETFs, there's no justification for denying a Bitcoin ETF, especially since they've already said yes to Bitcoin futures ETFs. Gensler is just basically expressing his own personal viewpoint. He's acting as though he's our mother and telling us to, don't eat too much candy. This isn't his call to make. He needs to put this ETF into the marketplace and let the investment community decide whether or not it's something we want to buy. And we ultimately do believe that's what's going to happen, which is why there's so much enthusiasm and excitement about this. I personally believe that over the next 2 years, we're going to see Bitcoin's price rise to as much as $150,000. That would be a 5x increase from where we are today. So I think that we're seeing a massive sea change. We're seeing legislation moving forward in Congress. We're seeing the SEC losing major lawsuits, one after the other. They lost Ripple, they lost Uniswap, they lost Grayscale, they're about to lose Coinbase. And we're seeing massive institutional adoption by pension funds and endowments and virtually every major brokerage firm on Wall Street, from BlackRock to Goldman Sachs, is getting involved. Gensler is wrong. He's out of date. He needs to acknowledge it by allowing the approval of these ETFs.
Even if he's wrong, even if it gets approved, there's a lot of space between 25 and 150, Rick. I mean,
there is.
What else would justify that upside? It can't just be the approval of this ETF.
No, it's not, but it's one in a long series of developments and enhancements. We're seeing maturation in the technology itself. We're seeing increased use cases on a global basis. We're seeing governments around the world developing and exploring CBDCs, central bank digital currencies. We're looking at crypto stablecoin legislation moving fast through Congress. That'll be followed by a broader crypto bill. We're also seeing that, let's not forget that early next year is the next Bitcoin halving. There occurs this only every 4 years, and every time historically it has occurred where Bitcoin miners get only half the coins that they used to get as a reward, that has led to a doubling, tripling, quadrupling in the price of Bitcoin in the following year. So all of these are moving toward what is now going to become the crypto spring, leading to the crypto summer as we leave the crypto winter behind. So there are a lot of really good stars aligning that I think will collectively contribute to massive new all-time highs in the price of Bitcoin.
Rick, you mentioned a lot of the big banks that have set their sights on crypto as well. So would this, if the SEC is eventually an approver of what Grayscale has put forward, and thus we see a windfall of other similar applications that now have the blueprint and how they can market and ultimately put a new asset into the market that allows more annexation to Bitcoin, is this better for the retail investor, the individual that's kind of banked on Bitcoin since 2011 or even 2015, 2016? Or is this more so a beneficiary for the institutions out there that are going to see all of the inflows into certain funds and ETFs and assets?
I think it's all the above. I think you're right on all points. This is clearly good news for Bitcoin because we're talking specifically about a Bitcoin ETF, but people will quickly realize that it's not just about Bitcoin. This is going to be a rising tide scenario. Coinbase will benefit as a leading crypto exchange. Independent IRA custodians like Choice will benefit. You will see major players, NVIDIA will benefit because it's another outreach for the sale of these GPU chips for the miners. You're going to see the entire industry rise as people begin especially to realize it's not just Bitcoin. We want to own a diversified crypto portfolio. That means owning Ethereum and Polygon and Solana and on and on and on. So it's going to be very good for the industry overall, which is going to bring more and more people into the crypto community. Keep in mind that 77% of financial advisors say that they have not been recommending crypto to clients because there's no ETF. So as soon as this ETF becomes available, independent investment advisors who manage collectively $8 trillion in investor assets, if they collectively put in 1 or 2% allocations to Bitcoin, we're talking about inflows of hundreds of millions of dollars, potentially tens of billions, into an asset class that's only worth $1 trillion right now. This massive inflow in a fixed supply market is going to have an incredible impact on the price of Bitcoin. And by extension, the other digital assets that will be getting a lot of attention as well. This is why we're seeing a rapid thaw in the crypto winter. The spring is coming very quickly, and that'll lead to the blooming summer. And that's why I'm really excited about the pricing of crypto over the next several years, and why it's worthy of a consideration for a small 1 or 2% allocation in a diversified long-term portfolio.
All right, I'll try to keep my swim trunks at the top of my drawer then. Rick, thanks so much for joining us here today. Really appreciate it.
Sure thing.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Are you in the mood for some milky Korean soft serve? Dan Halley isn't going to say no to a local delicacy. But what else is he getting his teeth into? Tune in to Yahoo Finance's next.
Shares of Manchester United are plunging today after the Glazer family will reportedly be taking the team off the market after failing to reach an agreement for the asking price. That's according to the Mail on Sunday. Striking a deal to sell the club has proven to be a complicated endeavor. The Glazer family began building a stake in Man U back in 2003 and completed the takeover by 2005. It was structured as a leveraged buyout with loans secured against the club's assets. The Glazer family's ownership has been controversial among much of the club's fan base ever since. Our next guest says the Glazers may be looking for the right strategic capital and clearly haven't found exactly what they're looking for. Joining us now is Steve Olenek, Mintz's chair of sports and entertainment practice. Steve, it's good to see you. What is the problem here? As you look at this process, which has been sort of rumored, never quite in the open, the stock has been all over the place. Is it the moment that's wrong, or is it the execution?
I think it's possibly the execution. I mean, right now, you're not getting the right person to buy it and the right purchase price. And I think with this specific deal, because it's such a historical vanity asset, I think they're not getting the price that they really want. And they probably think there's a lot more of a price to be had, and they're not getting it. So they're going to pull it off the market. It's a tough deal.
So what do fans ultimately want to see here? I mean, they want to see a sale, but
yeah, that's right.
It seems like for fans, and some of those fans might kind of overlap in the Venn diagram of investors in Man U stock as well. I mean, what is the best outcome? Is there a kind of leading contender that they have been pushing for but have not seen a deal come through for?
Yeah, that's a great point. I mean, I think what it is because the Glazers want a certain price and they're not getting it. So now they're going to threaten to pull it off, but they're also potentially looking to just drive up that price to get the price that they actually want. I'm shocked, though, that there hasn't been some more additional people to come into this, because potentially get a couple more principals in there, raise some more capital, kind of take it private, invest and give all the fans what they want, because although this is a complicated deal, this is one of the mega trophy assets to be had.
Well, that's what I was going to ask you about. Steve, if you can put in perspective for us, here in the U.S., we're familiar of some of the valuations of American football clubs, right? Put in perspective the valuations of some of the football, aka soccer clubs around the globe. On balance, how do they sort of weigh?
Yeah, I mean, the mega trophy assets in football are worth a lot, just kind of like how Jerry Jones values the Dallas Cowboys. Manchester United and the Glazers value it similarly to that. So I think it is a tough deal to be had. I'm just a little surprised that you haven't seen more principals kind of come in and try to go after it, because right now it seems like it's a two-trick pony race, and I'm actually shocked that more people haven't come into the race yet.
So what are some of the changes that we could see come through after there is a successful sale?
Well, I think, it's that real estate. More often than not in these deals, the people and the principals want the real estate into it, new improvements with all the facilities, huge investment into the club. You'll start to see client acquisitions. You'll try to go after, depending on who buys the team and how much money they have to play with, they will go after, try to get that next big superstar to come over to Man United and actually take part and actually try to raise the value even higher. But right now, because of probably the asking price, it's a tough deal to be had, because if someone's saying I want 6 and then they want 10, that $4 million delta is tough to come by and to actually, try to creep closer and closer together to actually get a sale done in the deal. It's a tough deal.
We've been talking a lot about the tightening credit conditions here in the U.S. affecting a host of different types of businesses. At this level, is that something that has an effect as well?
Yeah, 100%. I mean, because a lot of times when these deals are had, they have to go get financing a lot of times. They have to post collateral. I'm surprised in a deal like this that you haven't had a couple more additional people come in, mainly because I would tend to think that you could probably club some of these European banks that actually provide the financing to get them to where they want in terms of the purchase price. So kind of increase it, but use their balance sheet to lend against. So, like I said, because of this trophy asset, Man United, and how good of an asset it is, It's just that asking price that a lot of people just don't want to like, that between 6 and 10. I mean, that's a big adjustment in terms of purchase price. A lot of these.
You got to imagine that there would be some type of streaming consideration or broadcast consideration here too. Is there kind of a total reassessment that could take place based upon whoever that new owner is in terms of the visibility for the franchise and for the team, and where they kind of net out different broadcast rights?
Yeah, sure, absolutely. I mean, you have the deal right now with the Premier League with NBC, the Peacock, but you could also do some creative type of fan support, have subscriptions where you can buy exclusive content, try to really raise the visibility that way, increase dollars in by having pay a monthly subscription. So I think there's all these types of creative ways that you can actually maximize and increase the value of the club and actually get more out of it. But I think it's one of those things where the marketing, who's doing it, how they going to market the team, where is it going, the creative team behind whoever would actually acquire the team, what their thoughts are. I mean, some people, they look at these assets and they hold it, but the really good owners, they're very active. They're not just a passive owner. So I think there's a lot of variables that go in with this. And I think that, a team like this, because it is who it is in terms of where they are, where they're going to potentially be in the future. It's that vanity asset that everyone loves, but right now it's a tough purchase price to be had.
All right, there's probably at least one or two star producers here at Yahoo Finance that would pay top dollar for a subscription box for Man U. We'll see if that is to come forward in the future. Steve Olenek-Mintz, Sports and Entertainment Practice Chair, thanks so much for joining us here today. We appreciate it.
Thanks a lot for having me.
Absolutely. All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is what's next with Samsung.
People put it in the water.
That's pretty gnarly.
Water.
This is the heart and soul of Astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series, Next.
A mass exodus from Nevada's Black Rock Desert Festival, Burning Man, began yesterday after heavy rain left thousands of people stranded on site after a shelter-in-place order was set. Event organizers said 2 to 3 months worth of rain hit the area on Friday, which usually only gets less than 0.2 inches of rain during September. This particular, you're just seeing some of the images that have been posted via social media here, and many people trying to make their way out of the region.
Yeah, they've basically been stuck in the mud because literally walking in this would get your feet stuck in some places. You couldn't drive out. A lot of people drive in for this. So there were lots of stories of people walking many miles. There's no cell reception, mobile reception for many people. And, you know, Burning Man is one of those things that has sort of become a bit of a cultural joke in some ways because it's seen as a place where tech millionaires go to sort of let loose or whatever. But it is much bigger than that. There are lots of people who are nowhere near millionaires who go to this. It's more of a sort of artist festival, if you will, in many ways. There's no money on what they call the playa in Burning Man. There's only bartering exchange that goes on. You have to take out everything that you bring in. So it's, I don't know, I've always found it to be sort of a fascinating cultural phenomenon. I've known people who have gone to it. And this is one of the more notable endings to it, with people having so much trouble getting out.
Yeah.
You look very bemused right now, Brad.
I have had a friend invite me to Burning Man before, but it just overlaps with the U.S. Open tennis tournament that takes place here in New York.
That's a good reason not to go, I guess. All right, that does it for us. Rochelle Akufo for the next hour of trading. We'll have to ask her if she's ever been. Stay tuned.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's what I'm watching this morning. Nextdoor is doubling down on AI, and we'll head live to the Goldman Sachs Tech Conference for a conversation with the company's CEO this hour. And travel has surpassed 2019 levels this holiday weekend, but as delays and cancellations rack the industry, can the sector keep up with demand? Plus, Denzel Washington is back on top of the box office this holiday weekend, while this summer signals for new releases to come. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. As we can see here, looking at some red across the board, but trading in a relatively narrow range. We see the Dow here off about 60 points, or about 0.2% there. The S&P 500, a similar story there, down ever so slightly though, down about 9 points or 0.2%. Tech-heavy Nasdaq, they're also under some pressure as well, but ever so slightly, down about 12 points as well. Let's also check in on the Treasury market in this shortened week that we're having. We're seeing the 5-year down about 1.86%, the 10-year, up 1.86%. The 10-year also ticking up over 2% this morning, as you can see there, and the 30-year also up almost 2% on the day as well. A lot of information for investors to digest, looking at China's economic struggles continuing to linger. Right, well, while history says September is the worst performing month of the year by most metrics, there's good reason to give bulls hope in the 4 final months of the year. Yahoo Finance's interactive wizard, Jared Blickery, is here. So, Jared, why should investors be hopeful this month?
Thank you, Rochelle. Interactive wizard, I will take that. First, let's start off with what's been happening on the economic calendar, going back year to date or a year. This shows this is a city economic surprise index, and not surprisingly, when it's going higher, that means that economic data is coming in more surprising, or at least in a favorable way, than unfavorable. And when it's going down, that means we're getting some negative surprises. What I want to show here is that we are off the highs that we got in July of this year, and we have inflected a little bit off of these lows. And in fact, if I take a look at a chart of the S&P 500, we're going to see a similar story where we are off of the highs, but we have inflected off of these lows. And in fact, last Friday was a better than expected payrolls report. So we saw that inflection up, not only in stocks, but also that city economic surprise. But let me show you what's happened historically. Now, I'm going to show you going back about 20 years. This indicator is mean reverting, as you might expect. When it gets too high, where there's probably a little bit more favoritism or favorable expectations built into the market, and then it rolls over. And when it gets too low, well, that's extreme pessimism, and that's going to inflect up. Now, this doesn't track the stock market exactly. We don't necessarily have to see both of them going up, but back to the year chart here, you can see if we were to inflect up here, that would mean that the economic data is coming in better than expected. And in fact, even if we were to go down, we might have a market that is going up on bad news. Sometimes that happens as well. But why would that happen? Well, you have to think, are we in line for a recession? And does the economic data coming out, does that suggest that we are entering a recession? There are very different results from the time that the Fed enacts their first rate cut, whether or not we are in a recession or actually develop into a recession versus those that don't. So if you take a look at the global financial crisis and the dot-com crisis, when the Fed started cutting rates, even though that was cutting rates, that was a bad time to enter the stock market because a recession developed and we had a long, protracted bear market from there. If you take a year like 1998, when we avoided recession, but the Fed was actually cutting rates, well then, that was a good time to enter the market. So everything that's coming out of the market has to do with whether or not we're going to end up in recession. And unfortunately, we don't know that we are until long after the fact. That's because the National Bureau of Economic Research, they are the ones who decide whether we're not in a recession, and they do that with 20/20 hindsight. So we might even not know that for months to come. I'm going to close here. S&P performance by month of the year. September is the worst of the last 4 months of the year. This goes back to 1960. If you were invested only in September, you would have lost 40%. But as I have been showing, when we have a market that was really strong through July and just fell off in August, well, guess what? That tends to have a very strong end to the year, not only in September, but October, November, December. So point is, despite everything you've heard that September may be a terrible month for stocks, guess what? This year, it might be a little bit different.
And certainly taking a look at the VIX, that certainly seems to be the sentiment there, looking at the VIX at a 20-year low. So clearly they're seeing rosier days ahead as well. Our very own Jared Blickery, thank you so much. Well, while history says September is the worst performing month of the year, Wall Street seems fairly bullish. Analysts at Goldman Sachs cut their odds of a US recession earlier this morning, thanks to cooling inflation and a still resilient labor market. But our next guest says even though the economy is still chugging along, there are certainly some signs of a slowdown. Let's bring him in. That's Brad McMillan, Commonwealth Financial Network CIO. Good to have you on the show, Brad. So, I mean, the markets seem to be, charging ahead, still being bullish. I mean, we look at the VIX at a 20-year low at the moment. What do you think some of these markets or these investors are really missing right now when they're really just focused on the strength of the economy and perhaps not some of the risks?
I actually think the markets have it right. I do think there's some risks out there. We can talk about those. But when we look at a recession, for example, you don't see a recession when job growth is strong, which it is. Yes, it's down off the highs, but it's still at very strong levels historically. We don't see a recession when industry is investing, and we're seeing industry continue to invest. We simply don't see any of the signs of a recession, and that's what the market is banking on. The other thing, though, which is interesting, is the market is fading those fears about the economy. It's taking for the slowdown and saying, okay, the Fed is more likely to cut. Now, I don't think that's the case, but from the market's perspective, that's a sweet spot. Potentially lower rates and continued growth. And that's what I think we're seeing.
So are you not expecting a recession and you think the Fed can stick the landing based if these current trends continue?
The only thing that worries me right now is the consumer confidence data. That's starting to fall back. And certainly when you look at the job growth, we will have a recession. But right now, I don't think it's until next year and probably not until the middle of next year. We've still got some running room. I think the Fed is doing about as good a job as they could have done. So yeah, I think they're sticking the landing.
I mean, and Goldman Sachs out with their note called a soft landing summer, their group lowering the 12-month estimates of a US recession, the probability to about 15%. So then what are some of the risks that people should be aware of in the economy in spite of some of the bullishness that we're seeing?
Watch the jobs numbers. One of the things that came out, we saw the number of jobs available drop significantly. Now, it's still high, but if that drop were to happen again for a couple of months, that's something to watch for. Watch consumer confidence. We have a lot of people who are out there and they're not feeling as good as they did. And we've got some things coming up. We've got the student loan payments starting again. That could hit confidence. Even if people are working, they might not want to spend. I think those are the two key indicators that are going to signal trouble for me. And although they're still in a good place, they're not moving in the right direction.
So, Brad, so at the moment, we're seeing bad news being good news for markets. At what point does that tide turn? When does bad news become bad news for the markets as well?
Well, when you look at what's going on with the economy, Rochelle, everybody's saying, okay, things are slowing down. And the way that's being interpreted is, okay, that means the Fed is going to have to cut. So we've gone through this cycle several times where the markets convince themselves the Fed is going to cut. And then Powell comes out and says, no, we're not going to cut. And the markets sell off again. So I think we're in the middle of that cycle. Markets are talking themselves into believing rates are going down in the near to medium term future. And I simply don't see that as the case. But even so, because the fundamentals are still solid, we're seeing relatively limited volatility, which points to the VIX, as you mentioned.
And Brad, I want to ask you about, I mean, even though we have some of this uncertainty, but you still have the bullishness then, some of the sectors that you like, you listed energy and industrials. Energy has been picking up recently year to date, and industrials also started picking up in June as well. What do you like most about those two sectors?
Well, when we were talking earlier about where the growth is going to come from, I have some concerns about the consumer side, and confidence is the big one. But then when you look at business investment, one of the side effects that the labor shortage has given us is companies are investing more in capital goods. They have to invest in capital because they can't invest in labor. So that's driving the business sector. When you look at the Inflation Reduction Act, that's driven enormous investments in production facilities. So this is something that's not really on the radar. And because of that, we've seen those sectors of the market start to perk up. It's still not out in the public eye so much, but that's where the growth is over the next year or two. And that's where I think we need to be. And that, of course, is going to take energy. And we're seeing that price go up as well.
Brad, I have to ask you about the impact of the slowdown that we're also seeing in China in certain segments as well. How much of that is sort of weighing into sort of some of your estimations for the year for the US markets?
Frankly, when you look at the exposure of the US to the rest of the world, we have the lowest exposure as a percentage of the economy of any major economy. We're not an island nation, but we are pretty well self-sufficient. So when you look at China, the actual demand effects of the Chinese slowdown aren't going to hit us that much. Where we might get hit a bit is in the supply chain aspect of it. But that's more political than economic. And that's something that's already going on. So I expect the effect here really to be minor. I'm not worried about China. That's not our biggest problem.
And we'll certainly be keeping track of those supply chains, though, especially as they're getting more political pressure from the US as well as they battle it out over the chip market. A big thank you there to Brad McMillan, Commonwealth Financial Network CIO. Thank you so much.
Thank you, Rochelle.
All right, taking a look at shares of Apple under pressure today, down just ever so slightly. Even though they're releasing a new iPhone this month, the tech company is dealing with competition. Huawei announcing 2 new phones last month, the Mate 60 and the Mate Pro. Now, analysts say if Huawei can supply and scale these phones, it may threaten Apple's sales in the Asia-Pacific region. So a little bit of food for thought there for Apple this morning. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Seoul has more Starbucks stores than any city in the world, but Dan Halley isn't looking for a brown sugar shaken espresso. Find out why he's there on Yahoo Finance's next.
Let's do a check of the market sponsored by Tasty Trade. Looking at a mixed picture here as we're seeing the Nasdaq at least reaching for some daylight there, buoyed by Tesla, Meta and Microsoft lifting them there. The Dow still under pressure, ever so slightly though, by about 36 points. The S&P 500 there also down, but ever so slightly. Energy leading the charge, utilities and materials under some pressure this morning. Well, a recent study by Morgan Stanley found AI spending in healthcare is set to hit nearly 11% in 2024. To talk about the potential of an AI in medical care boom, Yahoo Finance reporter Anjali Kamlani joins us now. Hey, Anj.
Rather last month, Morgan Stanley came out with this report that really supports what we've seen in terms of that increase in investment in healthcare, specifically in drug use. Morgan Stanley predicting that investment will jump to nearly 11% from 2022, which saw 5.7%. Already, 94% of healthcare companies use AI or machine learning in some way, according to this report. And the only areas where you've seen less use tend to be in medical devices or anywhere where patients are directly involved, such as diagnostics and the like. We have seen use of that in, medical imaging and other areas. Drug discovery in particular has been top of mind for the last 2 years. Morgan Stanley has been covering that and emphasizing the opportunity for investors in the space for the last 2 years, even pre-pandemic. They did also have an interesting point about the reason why the opportunity for drugs is so big, saying, quote, every 2.5% improvement in preclinical development success rates could lead to an additional 30 plus new drug approvals over 10 years. And doubling that could yield 60 new therapies approved, which would result in $70 billion in value for the industry. So that's why the drug industry has been so quick to pick up on this versus other areas of healthcare, which are slower. We saw a perfect example of that during the pandemic with Moderna relying on AWS, that's Amazon Web Services, for selecting the vaccine that eventually made it to market. So it's already in use, and certainly there's a lot more conversation with, ChatGPT out there and OpenAI, but there are already areas where it's in play.
And we still continue to see that it's very early days there. Now, we're also seeing a lot of movement in the healthcare field. Just Friday, Novo Nordisk was briefly Europe's most valuable brand after introducing their weight loss drug, Wegovy, in the UK. Can you tell us what that means for the drug as well as the healthcare industry?
That's right. Just temporarily taking over Louis Vuitton parent for the most valuable company in Europe. People have been watching this climb for some time. We reported on this show when it was in second place just last week. And really that climb of that approval is indicative of what the company is facing. As I said last week, really the production level of the drugs, Wegovy and Ozempic, are the only things standing in the way for Novo Nordisk to expand exponentially right now. There have been so many benefits or potential benefits aligned with these drugs, including potential risk of heart disease, heart attack, fatigue. We know that they're also studying them for curbing addiction and other diseases. So when you look at the full picture, it really is a strong argument for the company, which is, I believe, trading up right now. Even though it didn't necessarily keep its first place, it certainly tells you the story of a company whose market cap briefly took over the value of the country's GDP, sorry. So, it's a very big story to tell, lots of demand still for that product. And we know the company is working to meet the still unprecedented demand. We do know those products are still on the FDA shortage list. So certainly a lot of opportunity there for that company.
Indeed. What a difference a year makes. My goodness. Thank you for getting us up to speed, Anjali Kamlani. Thank you so much. Well, Goldman Sachs analysts and top executives from across the technology, media and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference. The 3-day event kicks off today, and our very own Brian Sozzi is there to talk to some top movers and shakers in the business to help us understand what's driving the industry forward. Brian, take it away.
Hey, Rochelle, no vacation for us. We're at the Goldman Sachs Tech Conference here in San Francisco. Right out of the gate,
when Nextdoor CEO Sarah fired. Good to finally meet you in person, Sarah. It's been, 10 interviews, and I've never met you before.
It's great to see you in real life.
Actually, yes. So this conference very focused on AI and this AI moment. How should investors be thinking about this AI moment, given you've spent many years in tech? What does it mean to them, and what do you think it will mean?
Yeah, I mean, I think we're all talking about it, but it's also because it's happening. It's not a new thing. ChatGPT unleashed generative AI and really brought it in, I think, to the cultural domain. But of course, we've all been investing in data for now decades, and we're starting to see it come to fruition. Nextdoor is no exception, doing some pretty cool things on the AI front with our assistant and also with Vitality. Be happy to share more.
How will this AI moment impact a business like Nextdoor?
Yeah, so for us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you. When we're thinking about areas like moderation, we often stop you in your tracks and say, hey neighbor, would you like to rewrite that? Now we even offer you a suggestion of how to rewrite it in a way that's more constructive. So those are just two ways we're using AI ourselves, but it also starts to unleash what local data could mean broadly for models throughout the world.
It sounds like the Nextdoor platform is going to be fundamentally changed by AI. Is that fair?
That is fair to say, yes. Anyone who has big, unique data, where data is naturally tagged, I think they start to become a really interesting, unique asset.
I'm not lost, of course, we're at this Goldman Sachs conference, a lot of investors here, analysts, bankers, you name it, but is this year an investment year for Nextdoor? Given everything you're doing on AI, do you have to tell this room, maybe we don't see the margins we want, but we might see them 2 years from now?
Yeah, I think what we've told the street is we've been public now for almost 2 years, not quite. And we said, hey, we're going to raise money in the capital markets because we are a platform that has tremendous opportunity. Everyone in the world is a neighbor, but we need to go invest to look more like folks that we would consider competitors. That's on two sides. One is to continue to grow the platform. So we've over 80 million neighbors today, super engaged. And then the other side is to build our own proprietary ad tech stack. So we have been in investment mode. That said, in Q2, we showed both revenue growth and margin improvement. So we want to make sure that as we grow, we are giving investors back that margin leverage so that ultimately we can become a really high-performing, profitable company.
What's your outlook on the user growth front? We've seen a lot of people go back to the office, maybe not engage with a lot of social media platforms, but how do you see it at Nextdoor?
Yeah, so we see growth in multiple ways. One is WOW, is how we have talked about it externally. Our WOW grew about 13% year over year in Q2. But importantly, as people come to the platform, they're going deeper into the platform. And that's a signal to us that we're giving them more value. It might be in a cost of living crisis, ways to make money, find money in your neighborhood or in your home. It might be in a disaster, how to save yourself, save your neighbors, help your community. And so if they go deeper, that drives sessions to grow faster, frankly, than WOW. And if sessions grow faster, impressions go faster, and revenue grows faster. So we can see growth in multiple parts of the funnel at Nextdoor.
So you're gaining new data in new ways. This has to be now an easier sell to advertisers. You've really been focused for the past few years on getting more advertisers on your platform. What is your outlook for the next 12 months there?
Yeah, that's right. So for sure, the ad market has had its own issues over the last 12 months, as you know, as we've gone through corporates really pulling back in areas of variable spend. That said, in Q2, we got back to revenue growth. For Nextdoor, what we really sell on is, number one, we are real people at real addresses. That location data is really unique and differentiated. So for advertisers who have, say, an online to offline presence, like an Albertsons or a Walgreens, that's really important. Second, we're a very high intent audience. You come to get things done on Nextdoor. That's usually great for advertisers, including the smallest of businesses in your community. And then finally, we have that online to offline piece. So anyone that wants to do offline calls to action, stores, for example, we work really well for them. And that's done well in terms of new logos that we've added.
What's the biggest question you get from investors? And what do you think is coming at you at an event like this?
I think where you started, number one, is what can Nextdoor do with all the data that you have? How can you use the uniqueness of your platform? I think the second piece is they want to understand when will we be on that proprietary ad tech stack, because then we can use our data even as we drive revenue. And then third and finally, they of course want to understand when we can be a profitable business, and we're driving towards that. We're still small, relatively speaking, but we're very well capitalized, great team in place, and so we're excited to see where we can grow from here.
Profit soon?
Not yet talking about it externally, but absolutely we intend to show margin progression as we go through 2023.
We were talking off camera, a lot of weird events been popping up, increasing storm activity, not just in the US, really around the world. Does Nextdoor have a role in here in helping people navigate these situations?
Yeah, first of all, it's incredible the shifts we're seeing. There have been $18 billion disasters in the US alone in the last 12 months, 18. And that's caused about $175 billion worth of damage. So clearly something is changing. If you're on the West Coast, we're worried about fires. If you're on the East Coast, it's hurricanes right now. Middle of the country, tornadoes. That's where Nextdoor can really help because, of course, in an emergency, it's really neighbors who save neighbors. It's not emergency services. They usually get overloaded. So what we've done is for National Preparedness Month, September, we just launched our Crisis Hub. It's a great place to go to get information. And of course, the singular most important thing you can do is invite your neighbor onto Nextdoor as a way to be able to communicate with them in an emergency moment.
A lot of households, too, another emergency moment would be the cost of living. We talk a lot about it being a deflationary environment out there. Finally, it's really not for a lot of households. What are you seeing on the platform? Are neighbors trying to help other neighbors and saving a few bucks? Even a company like Walmart, which you sit on the board.
Yeah, absolutely. So yes, cost of living has been very top of mind for neighbors. There's usually 3 ways on Nextdoor that they can help themselves or help their community. Number 1 is to find a job or find a side hustle. So we've seen a lot of that in the summer, actually, with students home from university or as they go back onto college campuses, also still looking for that part-time job, but that's true for anyone. Second way is on our for sale and free part of our platform. It's our marketplace. Today we see over $1 billion a month put on Nextdoor, but about 20% of everything in that area is offered for free. So if you want to find something like a table and chairs, someone in my neighborhood was looking for that last night, Nextdoor is perfect for that. And then the final area where people tend to come to make money is also just small businesses. They're often getting going in local communities. Nextdoor might be the first place they go to market. They can do it for free by claiming their business page. But again, that local economic growth is really important, all the way up to, as you point out, the Walmarts of the world as well.
Before we let you go, we initially started talking to right when the COVID-19 pandemic started. Looking back, how are you a different leader today than when that started?
Oh, wow. There was certainly no playbook. Like, no one handed me that here's what to do in a pandemic. I think we have shifted, I read a lot that article over and over about peacetime CEOs and wartime CEOs. And I think the last 12 months, or maybe even the last 24, kind of coming through COVID and at the other side, has felt a little bit more like wartime, frankly. So number 1 is being more directive while trying to still stay very empathetic to your employee base, to your investor base, to your customer base. I think the second thing is being incredibly transparent about why you're doing something. To me, I've always been a leader that's tried to lead by saying, I'm going to tell you it all, warts and all, and that's how I'm going to kind of win not just your mind with the numbers and data, but also your heart. And then I think finally it's looking for purpose. Great purpose-driven companies, I think, can really endure no matter what comes at them. And I think Nextdoor is that, the purpose of cultivating a kinder world where everyone has a neighborhood to rely on. I can't think of anything better that I want to get up in the morning and go after.
Well said, and good to finally meet you in person. I know it's
wonderful.
a very busy event. We'll let you go. Nextdoor CEO Sarah Farr, thanks for stopping by Yahoo Finance. We appreciate it.
Thanks so much.
Rochelle, back to you.
All right, wonderful stuff there. And a big thank you to our executive editor, Brian Sozzi, for bringing us that interview. We've got more big interviews lined up all this week. Brian Sozzi will speak with GM CEO Mary Barra, Paramount Global CEO Bob Bakish, Lyft CEO David Risher, and Hasbro CEO Chris Cox, just to name a few. Keep it here on Yahoo Finance. All right, all your markets actions still ahead, so stay tuned. You're watching Yahoo Finance.
Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. We'll find out when Yahoo Finance is next.
August weighed heavily on crypto, with Bitcoin down almost 12% at the month's end. But will the slump stretch into September, or could the end of summer bring a boost? Joining me now with more is Yahoo Finance's David Hollerith. Hey, David.
Hey, Rochelle. So Bitcoin is usually a more heavily traded, September is usually a more heavily traded month for Bitcoin as opposed to August. That being said, at least historically, it doesn't look quite as good. Based on historical data for 8 of the past 10 years, Bitcoin's monthly performance for September is usually down or a sell-off, and the mean is about down 6%. Now, that being said, where we've come since August, we've seen 2 really big moves in August, and one was up, one was down, and then down again. So we're kind of at neutral. Quarter to date, since the beginning of July for the third quarter, Bitcoin sold off about 16%. And the focus going into September is obviously about the Bitcoin ETF's approval. We have the grayscale case verdict that's come out, and now the SEC has about 40 days to respond to that decision, and that might shed some light on whether or not the agency is looking to change their previous decision making about whether or not to approve a spot Bitcoin ETF. But that comes in October, and also in October, a number of other asset managers are also filing for a spot Bitcoin ETF, and their applications can either be delayed or approved around that same time. The SEC also has a Ether futures ETF, which is a slightly less controversial product that approval is looking to be rolled out possibly as soon as October. So we have a lot going on in terms of the U.S. market, looking at the SEC's approval and decision making based on crypto-related products. But I mentioned those 2 drops in August, and that sort of goes back to sort of what the problem has been is that the crypto market, Bitcoin in particular too, has had very low or thin trading, and that's caused a lot of these big movements that normally in past years wouldn't move Bitcoin quite as much in terms of these one-day movements we see where it's up 11%, down 11%. And it's kind of interesting because the ETF is sort of one thing that could sort of stunt some of the volatility there, because obviously it brings more access to the market and would, in particular, allow the market to grow a little bit. There'd be wider trading. So we're kind of faced with a chicken or egg situation looking towards the fall for Bitcoin and the crypto markets. And a lot of it is focused on U.S. agency approval or federal agency approval.
We know Bitcoin enthusiasts looking for some light at the end of the tunnel. Perhaps they'll get it. I mean, former SEC Chair Jay Clayton telling Forbes that an eventual approval of a spot Bitcoin BTF is, quote, inevitable. We'll have to see what happens at the end of that waiting period. Big thank you there to our very own David Hollerith. Well, folks across the U.S. traveled at record rates for the Labor Day weekend. Travel numbers surpassed both 2022 and 2019 levels. The TSA anticipated a big influx of airport travel, with 14 million Americans expected to fly for the holiday. That's an 11% increase from the year prior. I'm joined now by Brian Kelly, the Points Guy founder. Good to have you on, Brian. So, in terms of plane, trains and automobiles, all the different ways that people traveled over this Labor Day holiday weekend, where did we see the strongest dominance here?
Well, air traffic is up, especially in international travel. And I do have to give kudos to the airlines. It was pretty smooth sailing, even with the storm, which can easily cause chain reactions like we saw in the middle of the summer. So the way I look at summer 2023 was we had a pretty good Memorial Day. July, we had some dark moments in those mass cancellations. United had their meltdown, but we ended pretty strong. So I think all the airline executives can take a little bit of a lap here as they gear up for what's going to be I think an unprecedented holiday travel season as well.
So how surprising was it then, especially, we were, expecting a lot of disruption there, especially from the hurricane season. Did it just not pan out as expected, or did people sort of make other plans and work their way around it?
No, we got lucky, I think, especially with the storm and how it impacted travel. It wasn't as bad as we expected. And, storm season really heats up September as well. So we're not out of the woods quite yet. But in comparison to the busy travel season, I think things are pretty good. There are still key concerns. Air traffic controllers, there is a shortage. That's what helped spur the July meltdown of United's meltdown. There's going to be a pilot shortage. That's going to continue to be an issue. So I wouldn't say we're back to pre-pandemic normal, where we're back. We did handle this big increase in passengers this weekend pretty well. If you remember, summer 2022 was all about the meltdowns across Europe with 10,000 bags stuck at Heathrow. I traveled throughout Europe this summer and things were pretty smooth sailing. So I will say, I think the travel industry we're not back to normal, but I do think we're in a good place as we, shift into the busy holiday season in a couple months.
So, Brian, as you mentioned, things like the pilot shortage, the shortfall that we had, especially, a lot weren't able to train during COVID. There were a lot of other extenuating circumstances that are still working their way through. What are the expectations then for how these airlines are going to manage the summer travel season?
Well, I think we're seeing the airlines are giving huge concessions to the pilots. They're getting big pay raises, and they're even talking about raising the retirement age, which I think is, a short-term solution to this. But all the airlines, United Airlines actually started their own pilot academy to start training the next generation of pilots. We'll see if that's really a success or not. There's some mixed feelings on that so far. But overall, the industry, our government, everyone's pointing fingers at each other, but the government needs to do a better job at recruiting new air traffic controllers. And we need to embrace technology. Frankly, facial recognition technology that can help people get through airports quicker. I think AI can help the airlines. It's ridiculous nowadays. You still have to wait hours on the phone to talk to an agent when there's AI technology that can give self-service to passengers. So it's going to be more than just hiring new pilots or air traffic controllers. I think the industry has to embrace technology.
And you raise a good point because, yes, we are still sitting on hold trying to resolve things when, there's missed flights or delays. And then on top of that, I feel like, maybe I'll drive. I shed a tear when I was filling up my tank this weekend. Still very expensive to fill your tank at the moment. When are we going to start seeing a bit of relief for the consumer at this point?
Well, the markets are a little shaky today due to rising oil prices. So, I have no idea what oil is going to do. I don't foresee gas prices coming down more. The silver lining with airfare is, domestic airfare has come down quite a bit, but international, my breath was taken away from me this summer when I was booking Europe trips. Luckily, I used my frequent flyer miles. And I recommend others to do the same because, especially in business class, tickets were 7,000 round trip on many dates this summer. That is much higher than pre-pandemic, even when all the business travelers were traveling. So the luxury consumer is now used to flying business class. The airlines know that. And we're seeing this fall, winter, all the major airlines are putting their premium aircraft to the Caribbean and Mexico. We've seen an unprecedented buildup. United Airlines is focusing on South Pacific with new flights to New Zealand. So it's an interesting game, but consumers still have that huge urge to spend, especially in the premium cabin.
So, Brian, then I have to ask you then, your top 3 tips or your top recommendations for what people could do if they haven't already, saved up for their summer travel season or even their winter travel plans. What could they do right now to save the most money and really take advantage of the deals?
Yeah, so my tip is book summer 2024 travel now using your frequent flyer miles. I will tell you the U.S. frequent flyer programs, they have had inflation in terms of the number of miles needed. Here's my tip. Use foreign frequent flyer programs like Air France's Flying Blue. They currently have transfer bonuses from Amex where you can really get maximum value. Virgin Atlantic, Air Canada Aeroplan. So foreign frequent flyer programs are often the best way to get most bang for your points. And there are a lot of big credit card sign-up bonuses right now. So at thepointsguy.com, we've got a listing of all the top deals. And just be a little bit savvy. There are tools out there like expertflyer.com or Roam, ROAME.travel. There are tools that will actually scan the airline's inventory for award seats, and they'll even alert you when seats open up. So plan in advance and book your summer 2024 travel now. You can always change it if you need to.
I'm feeling kind of bad that I did not plan any of my winter travel and you're saying summer 2024. So I guess I have to hurry up and get on that. A pleasure having you on the show again. Brian Kelly, the Points Guy founder. Thank you so much.
Thanks for having me.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is what's next with Samsung.
You can put it in the water.
That's pretty gnarly.
Water.
This is the heart and soul of Astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series next.
US semiconductor giant Qualcomm will supply chips for Mercedes and BMW's infotainment systems, including displays and voice features. Let's get the details with Yahoo Finance's Pras Subramanian. Hey, Pras.
Hey, Rochelle. Yeah, nice little coup here for Qualcomm over its rival, NVIDIA. As you mentioned, Qualcomm supplied chips for infotainment and self-driving tech for Mercedes and BMW. These chips will appear in new Mercedes E-Class and will also power some of those voice commands you mentioned in new BMWs as well. This as Qualcomm sees revenue for smartphones slump recently, but autos are a bright spot here, with sales climbing 13% last quarter in that sector, while outlook for the smartphone business fell short. CEO Cristiano Amon highlighting the importance of the auto sector, with Qualcomm seeing revenue rise to $4 billion by 2026 and $9 billion by the end of the decade. Rochelle.
I mean, certainly smart making that increased pivot into autos when you see what we're seeing with phones and PC slumping. Now, let's also talk about competition, though, in the EV space. There was a notable concept car debut for Mercedes this weekend. What's the deal there?
Yeah, so kind of a stunner here at the Munich Auto Show over the weekend. Mercedes debuted their CLA EV here. Sort of the CLA class, normal gas-powered cars. They're going to kind of cancel that car, sort of see it off into the sunset. But then they announced this EV that's going to come up based on a concept that'll be sort of almost production ready. This new car, quite stunning in its looks. Going to have also around 400 miles of range, if not a bit more than that. So it's sort of taking on Tesla, the Model 3, which is around 320 or so. So Mercedes up in the ante there from a range point of view, but also, as we know, Mercedes knows what they're doing with luxury. A nice widescreen digital display in that cockpit. It's going to look great, I think. So we'll see that probably the next year or two coming out from Mercedes. Can't come soon enough for the brand, I think.
I love that. And I love the fact that even though, these EVs don't need a grille, this one has one on there because it still makes it feel a bit more special. I cannot wait. I'm sure at some point, hopefully you get to try that out for us. Always great to have you on. Our very own Prostor Romanian.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Howley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's next.
Denzel Washington has made a return to the top spot at the box office this holiday weekend with the third installment of Equalizer, which is expected to wrap up the 4-day weekend at $42 million. That's according to ComScore. Now, Barbie took the second spot with Blue Beetle, Gran Turismo, and Oppenheimer rounding out the top 5. Yahoo Finance's Alexandra Canal joins us now with the details. Hey, Ali.
Hi, Rochelle. Yes, a solid Labor Day weekend at the box office, thanks in large part to the Equalizer 3. And Labor Day weekend, it hasn't historically been a holiday that draws people out to the theater, but this year seems to be a noteworthy exception. The film made $34.5 million in its opening weekend, and as you mentioned, is estimated to pull in $42 million over the 4-day holiday weekend. And if we compare that to years past, that makes this year the second highest Labor Day weekend ever, behind 2021. And remember, in 2021, we saw the debut of Marvel's Shang-Chi and the Legend of the Ten Rings, which pulled in just under $100 million in that opening 2 years ago. So still a very strong start here, especially considering we don't have a Marvel film to save the box office this time around. And it's interesting to see the different types of movies that are outperforming at the box office this year. Obviously, The Equalizer, huge star attached to that with Denzel Washington, an action movie. Typically, those are the movies that do well at the theater. However, this year, we're seeing different types of films emerge, like Barbie starring Margot Robbie. That was a huge success this summer. In fact, as the summer comes to a close, the box office revenue hit $4 billion for the first time since the pandemic. So that's a huge win moving forward. I will say there are certainly risks heading into the back half of this year. For example, Warner Brothers' Dune 2, that was pushed from November of this year to March of next year, and that was one of the most anticipated films of the fall. And the fact that we don't have that much content heading into the back half of 2023 is concerning, especially amid these ongoing strikes in Hollywood. Dune 2 was pushed because of the strikes, and we could see potentially more reshuffling of the box office calendar as we head into the end of the year. So a lot to keep track of here, and certainly the strikes are going to continue to have an impact. But so far at the box office, we're still seeing people come out to the theater, which is encouraging.
It's true. And even with a big name, I mean, look at Indiana Jones. That didn't do well. So, I mean, it's kind of hit and miss for some of these as well. Also want to shift gears and look at the streaming space. Disney making a move to push users to subscribe to Hulu and its live TV offerings. What can you tell us there? That does seem like a reversal of fortunes here.
Yeah, so this follows the dispute that we saw late last week with Charter Communications, which is the parent company of Spectrum, and Disney. If you remember last week, we had a lot of angry sports fans who were unable to watch the U.S. Open, unable to watch college football after Disney and Charter failed to reach an agreement. Disney then pulled all of its owned and operated channels from subscribers of Charter, so you weren't able to watch ABC, ESPN, even the Disney Channel. So that was very disappointing to those users. But now Disney has an interesting tactic this morning saying, you know, if you're a subscriber to Charter and you're disappointed with all these blackouts, why don't you go and subscribe to Hulu Plus Live TV? So that's an interesting move to try and pump your own streaming offerings there. But we've heard from a lot of analysts that say Charter might be okay at the end of the day with this if a dispute is not resolved. However, this could have larger implications to the larger media space, considering companies like Disney, Warner Brothers Discovery, Paramount Global, they depend very heavily on the cash flow from linear networks. So if this sets a precedent moving forward, that could be devastating down the line. So this is something we're continuing to track and watch very closely, since this feud, it's still ongoing at the moment.
I'll certainly be keeping track on that. It certainly does put front of mind all the streaming services available and just how much we're spending on them, and then the sort of the streaming live TV options. It's a lot for us to have to deal with at the moment, but I know you'll keep us up to speed on all of it. Thank you so much, our very own Ali Canal. Right, well, let's get you a final check of the markets as we head into the noon hour. Still bouncing around that narrow trading range here at the moment. All three in negative territory. The Dow there off about 60 points. The S&P 500 there also down about 0.25%, about 10 points. Tech-heavy Nasdaq there briefly was in positive territory, has now turned negative. Down ever so slightly, though, about 19 points. I mean, obviously, this is a very shortened trading week for the markets, so perhaps people sort of easing into it, and then sort of a lot of economic news they're still digesting from last week with the jobs data, as well as some of that continued slowdown that we're seeing in China as well. Well, that'll do it for now. I'm Rochelle Akufo, but I'll be back with you at 11 a.m. Eastern, but be sure to stick with us all day on Yahoo Finance. We'll see you then.